I want to welcome you to this morning's event, How Market Manipulation Creates Opportunity. It's Saturday, June 28th. You got John Hopkins here. I'm just going to be very brief because we got the main event coming in. We got a lot of people with us this morning. No surprise. We got Tom Boley. And when Tom talks, people listen, and there's good reasons for that, as you'll see. Hey, if you like what you're seeing and hearing, make sure you hit the like button and subscribe to our channel. Help us spread the word about earnings beats. Of course, today's event will be recorded. You'll get an opportunity to, review it at your leisure. But it's going to take a while this morning, but you're going to want to stick around for the entire event. And I want to mention one other thing too. Going to have a very important discussion about membership a little bit later in the program that you don't want to miss. But let me make sure Mr. Bo. Oh, I want to say one other thing too before I bring Tom in. Love to hear where people are from. So if you can just in the chat tell us where you're coming from, that would be wonderful. We love to see where everybody is joining us from all across the country and the world. We got members all over the world. All right, let's make sure Mr. Boley's in the house. Good morning, Tom.
Hey, good morning, John. Good morning, everybody. Great to see everybody this morning. Welcome. What's that?
I'm really excited about this morning. This is going to be a great one. And of course, followed up by Monday when you'll have your Q3 market update. We'll talk about that later too, but I know you have a lot to cover. So I'm just going to step to the sideline for now.
Yeah, I got to tell you, I'm really excited that this morning we just got our all-time highs yesterday.
Yeah.
So, we did this 90 days ago.
Yep.
And, I talked about, I went back and listened to a little bit because I wanted to remember where we were and what I was saying back then.
Yeah.
And it was right at the end of March we did this. And of course, the market was going down and we had that bottom early in April. And based on some of the intermarket stuff that we were looking at back then, I said, I thought the market had one more move to the downside, which we saw about a week to 10 days later, put in that big bottom. And then we were off to the races. And I talked about us moving back to all-time highs. And so I thought it was kind of almost ironic that, we saw those all-time highs hit yesterday, right before this event.
And at some point, I'm going to do a graph. I can't wait for this one as we get to the end of the year. Just so people know, every year we do a market vision where Tom gives his annual forecast. And all the other analysts around the world and country are giving their forecasts and talk about a yo-yo. This year, I have never seen more analysts change their original forecast, going lower, and then things start picking up and they get higher, and then they get better, they move higher so they can say they nailed it. But I'm tracking all this. So you have been one of the very few steadfast. Not once did you come out and say, I'm changing my forecast. So I think that's really important.
Yeah. Well, we did call the top, but I look at it as just a short-term blip in a longer-term secular bull market advance. And that's what we had. It's over. Market back to all-time highs. And I think we got a great market looking ahead. Although I'll talk more about that on Monday. And we'll talk about that Monday event coming up a little bit later in the show as well.
All right. Go.
Yeah, we are getting a lot of folks responding. I can tell you that I am in TQQ, South Carolina. So I'm just about 20 minutes south of Charlotte. John is in Charleston, close to Charleston, South Carolina. And so we're both, in the Carolinas. I saw there were a few Carolinas here, but also I see folks from all over the globe, which is really cool. So I want to welcome everybody in. That's great. And again, if you haven't put your location in, feel free to do that. Also, one thing that'll really help us is throughout the show. If you really like what you see here, hit that like button, and also subscribe to our channel. If you're new to Earnings Beats and you want to, follow what we do, I think you're going to absolutely love this presentation. I really do. This is, what we do. I spend a lot of my time doing research in the market so that I can make calls like I did back in February on the top and like I did in April at the bottom. It's understanding history. It's understanding perspective. It's also understanding the signals that the market's giving us at any moment in time. and then using all of that information to come up with the best possible scenario on what likely lies ahead. So what we're going to do today, let's go through and talk about the agenda here for just a second. And I wanted to make sure that we've got, that we got proper coverage of a lot of things that I think are important in the market right now. So obviously, introduction. You should know us. Most of you probably know us by now. Of course, John Hopkins, president of Earnings Beats, was just on with me a second ago. I'm Tom Boley, chief market strategist here at Earnings Beats. Again, such a pleasure to have everybody in here. I know it's a Saturday morning, and I promise I will try to get through everything as quickly as I can, but there's a lot of really good information. I don't want to rush through it. So just count on the fact that this is probably going to go about an hour, hour and a half, and then I'll take questions. I got things to do. It's Saturday for me too, so I want to get out of here as well. But this is stuff that we're really passionate about. And I know just because you're in here on a Saturday, you're very passionate about it as well. So again, thank you all for taking time out of your day, and let's go ahead and get this thing started. I'm going to start off with the tops and the bottoming calls. The reason I want to start there is not necessarily to pat me on the back, but we got a lot of folks here that are new to Earnings Beats, don't really understand what we're all about, what we do. So I want to talk a little bit about what we do. And what we do is we provide market guidance, among other things, that I think is top of the line, best in our industry. So we'll talk a little bit about what happened here in 2025, what we were looking for. I'm going to give you some perspective. I think that's one thing that's really lacking in the market. You talk about what's happening right now and you get so caught up in the news and everything that's going on around you, you can't step back and just take a look at the big picture and see how the small stuff, the stuff that's coming up on a day-to-day basis, kind of fits into that bigger picture. So we're going to spend some time talking about perspective today. Topping signals. If you want to know how you call tops in the market, how we call tops in the market, I'm going to show you some of the key signs. And you can use that going forward. The one thing I would caution you about, when you top, it's like a bunch of puzzle pieces coming together simultaneously at the same time to kind of beat us over the head that there's a top in play. Now, I'm going to talk about, 6, 7, 8, 10 different things that we want to look for in terms of trying to call market tops. And what members and non-members have done in the past is they will pick and choose, and they'll see, okay, well, here's one signal that Tom talked about. If it does this, it's a top. And so we get a lot of questions and say, oh, what about this ratio? I saw it went down last week, and the market went up. Does that mean we're topping? And I'm like, no, that's one piece of the puzzle. It all has to come together. And you'll see in this presentation how it all comes together when major tops form. So it's really, really going to be interesting for you to kind of put it all together and to just open up your mind. If there's one thing that I really would like to avoid, hopefully I won't see a single comment. I know that's probably not going to be the case, but I really hope that there's not a single comment today about politics. Can we just not talk about politics? Because as far as I'm concerned, the stock market is independent of the White House. It's independent of politics in the US. Rarely does something going on in the White House have a massive impact on the stock market. I've done studies. It doesn't matter if there's a Democrat, Republican in the White House. The stock market does roughly the same over the years. So if you want to take your politics and your political discussion somewhere, hopefully take them elsewhere, because I really don't care about politics. I call the market based on what I see on the charts. And I don't see anything about politics on the charts. I just see prices. I see money rotating into certain areas and out of certain areas. And that's what I use to call the market. I look sometimes, because I'll talk about the Fed. Most of you, if you know me, you know I'm not a big fan of the Fed. And I base it on what's happened in the past, how the Fed's gotten things wrong. They're always late to the party. And I also look at what's going on in the charts. So when the Fed tells me they're worried about inflation and I see money rotating into growth, I'm like, what inflation? The big Wall Street firms with all their PhDs and MBAs don't seem to be concerned about inflation. They're pouring into growth stocks. Why should I be listening to the Fed? I'm falling behind. I'm not watching the money. I'm getting too concerned about all of the what ifs out there. So Put all that stuff to the side. Let's focus on the charts today. And I'm going to show you exactly how we do what we do. After I go through those topping signals, massive market manipulation. This is about as important as anything. I discovered a lot of this back in, coming out of the pandemic and seeing that massive drop in 2020 and then the massive reversal out of it. Money was starting to rotate into some very aggressive areas of the market, even while we were talking about the Great Depression 2.0. The pandemic was not a financial crisis. It was a healthcare crisis. Big difference. Same thing developed in 2022. As the market was going down, we started to see at the bottom money rotating. Wall Street was moving out of defensive areas and into aggressive areas before the bottom hit. And if you see that coming, you can predict a bottom. You get a lot of folks say, "Oh, you can't predict market. You can't time the market." Check out this presentation today, and then I'll let you be the judge. Anyhow, I want to talk a little bit about some of the things that we can look for going out over the summer. So a few potential winners ahead, and then I'm going to take your questions at the end. Now, if you do have questions, if you could kind of try to be specific. Sometimes, I'm going to be talking about a lot of things over the course of the next 60 to 90 minutes. And we get to the questions and someone will say, "Well, you showed that chart where we were hitting the high in April. And I'm just wondering what you think about, where we are now." And I'm like, "Which chart?" I don't know I just went over literally dozens of charts. So I don't know which one you're talking about. So if you do ask a question, just remember, it's probably not going to get answered for a while. Try to be as specific as you can in your questions. And I certainly will try to get those answered at the end of the show. All right. I'm going to go ahead and jump in here. So let me get my screen set up for everybody. Make sure we are set and ready to go.
Tom, you're going to have to share your other screen.
I'm sharing. Hold on.
Thank you.
Okay. So the first thing I want to do is, many of you are new to Earnings Beats and what we do. One of the things that we do is I do a lot of free YouTube presentations. I also write a lot at Stock Charts, where I've been writing since 2006. So I've been there now for 19 years, got a huge following as a result. I mean, obviously, if you're going to write somewhere for 19 years and you make some pretty good calls, people are going to follow you. So when I write articles, a lot of times you'll see that because I have been writing for as long as I have, got a lot of folks following me. So you'll find some of my articles under the popular articles. But if you just want to specifically go in, I mean, you can go and you can look. These are all posted chronologically in order of time. So you can just scroll back and try to find my articles or others. I mean, we have some really there's some great authors at Stock Charts, folks I have a lot of respect for. Find some of the folks you like and follow them. But if you want to find my specific blog, right here, there's a drop-down menu. You go over to Stock Charts, click on Articles, and then you'll have this drop-down menu. And you click on that, come down to the bottom, Trading Places with Tom Boley. Click on that, and then you can go through. You can actually, find the blog archives. You can go back years. Now, this goes back to 2015. Like I said, I've been writing since 2006. So I guess they've got a limitation, maybe 10, 11 years. But you can go back and find all my articles. So you can go back and read whenever, whatever you want to read about. But I just point this out because if you come over and you do like my articles, I would just ask that you follow the blog. If you type in your email address, hit that submit button. What that'll do for you is anytime I publish my articles, I don't know when I'm going to publish. I try to publish maybe one on the weekend. But if you follow the blog, you will then be provided the articles as soon as I publish them. So whatever your email is, if I write an article, hit the publish button. If you're signed up as following this blog, the article will automatically be sent to you. So you don't have to come looking at Stock Charts to see whether or not I've posted recently or anything like that. It's a free service at Stock Charts. They will not spam you. They don't sell your information to third parties. It's fine. It's safe. And I would recommend doing that, not just for my blog, but for anybody's at Stock Charts that you enjoy following. So I want to make sure you get that out of the way. Now, what I'm going to do, because a lot of the information that we give to our members is private. It's members only. We have a paid service. Most of what I want to point out are some of the calls that I've made in the public that you can verify. I mean, we got tons of members here, and I ask our members, if I say something that I haven't done, feel free to come on and tell everybody that that's not true. But likewise, if I've given you some great information and I'm pointing it out, come on and say, hey, I'm a member. I've seen it. I've seen Tom. I've seen earnings beats at work, and back me up on this. So let's start with some public calls that I've made recently. This is some of the topping and bottoming calls. This is February 1st. Now remember, the stock market topped on February 19th. So I posted an article, and if there's one thing I think that I'm known for is having conviction. If I start seeing something in the market, either bullish or bearish, I will write about it, and I will write about it with conviction. I don't come out on February 1st and say we're topping with bearish action ahead, and then come out on February 2nd and talk about how bullish the market is. If I'm really starting to feel those big, those major storm clouds starting to build, I'm going to tell you. So February 1st, I'm talking about we're topping with bearish action ahead. Now here's a 100-year chart of the S&P 500. So I'm generally going to be bullish. I mean, you can see the market over the last 100 years goes up a lot more than it goes down. So you got to pick your spots to be bearish. Don't just always be bearish. If you find that you're always negative, the stock market, you really need to reassess. Maybe even talk to a financial therapist. And I'm only half joking about that, because you're missing out. The stock market goes up a lot more than it goes down. You need to have signals beating you over the head that it's bearish, not because you heard something on CNBC or because you don't like the president, or look at the charts, look at the price action, look at the rotation, some of the things we're going to talk about today, and make your calls based on that. Be objective, be unbiased, follow the money. Okay. So that's a 100-year chart. That doesn't lie. Now, I talked about 2022 here and the fact that it's, was bearish and all. And I said here in this article, this is again, February 1st. This was 3 weeks before the market topped. I said, currently, I'm not seeing as many bearish signs as I saw back in 2022, but I am absolutely watching the bearish signs develop. The analogy that I would use, I'm just reading from this article, is that major storm clouds are brewing on the horizon. Will we be able to skirt the storm, or are we about to get a direct hit? Now, I don't know how I could be much clearer. I'm beginning to think direct hit, meaning that we got problems. That was February 1st. So I went on, talked about sentiment, some of the issues there. I talked about the event that we had coming up. We had a bearish signals abound, how to navigate this uncertainty. So I'm always doing these free events, trying to help the public. And that was kind of the lead in, that there's a lot of problems brewing. And I gave folks an opportunity back on February 3rd to join me there. Next, here's February 23rd. Now, remember, we topped on the 19th, which was a Wednesday. So I wrote this on Sunday, February 23rd, just literally a couple of days after the market topped. I said the top is confirmed. And now it's just a matter of how low we go. Now, there were a couple reasons for this, but I wanted to show you a chart here. First of all, here's the S&P 500. And the XLY XLP ratio, I'm going to talk about this a little bit more later in the show, but that's discretionary versus staples. There's a tremendous positive correlation between the direction of the S&P 500 and the direction of discretionary versus staple stocks, that ratio. And this is the correlation. This is the positive correlation in the blue shaded area. Here's the inverse correlation. This is when they go in opposite directions. The S&P goes up and discretionary underperforms staples and goes down. Doesn't happen very often over periods of time. Look at this, almost never. So if you don't learn anything else from today, understand that our GDP is comprised roughly of 2/3 consumer spending, and knowing which consumer stocks are performing better whether it's discretionary or staples, will go a long, long way in helping you determine which way the market's going to go. Just one signal. That's simple. It's a ratio. You can look at it every day. Now, I'd be careful about trying to read too much about it every day because it's more of a longer term kind of a feel to it. But you can pull it up on stock charts every single day if you want. And stock charts, by the way, for those of you who may use TradeStation or some other platforms, I've always traded off of, well, I don't physically place my trades on stock charts, but I use the platform to do on my watch list, our chart list, what we call our chart list over there. I use a lot of the stock charts platform to create all these charts that you're going to see today. We have no financial affiliation with stock charts. I want to make sure that's clear. I write there. I use their platform. I certainly do a lot of marketing for them. And I also do a lot of marketing for ourselves over at stock charts, but there's no financial relationship. Some people think we're stock charts. We're not stock charts. I just simply have written there for 19 years. So people maybe make that assumption. Now, this was the confirmation right here. This is a 5-day intraday chart showing you what the XLY was doing throughout the day. It's a 10-minute, every one of these candlesticks is a 10-minute bar showing what happened over 5 days. Now, in particular, the stock market topped on December 19th, right here. This was on the Wednesday, the 19th. On Thursday and Friday, there was mass exodus out of consumer discretionary stocks. Not a gap down, not everything's horrible. Let's just gap the market down 3%. No, this was actually a gap up. And the XLY on Friday sold off from almost $225 down to $217.50 before a little rally into the close. But that was a 2.5% drop on the XLY, and the selling was all day long. Look at the XLP. This is consumer staples. Look what happened on consumer staples. Going the other way, buying all day long. Why would you be buying? Why would money be rotating into defensive areas? We just set an all-time high 2 days earlier. Folks, CNBC, you're not going to have analysts going on CNBC and saying, hey, folks, we're getting out of the market now because we see a top and we see the market going lower over the next 4 weeks, 6 weeks, 8 weeks, whatever, 6 months. They don't make those announcements to the public. They make them on the charts. This ratio, this difference in performance intraday between the XLY going down and the XLP going up, there was a 4 percentage point swing. XLY sold off all day long, 2.5%. XLP was bought during the day and went up 1.5%. Down 2.5%, up 1.5%. The difference is 4 percentage points. Why is that important? Well, from the financial crisis low in 2009 until the time of that posting in 2025 in February, that relationship between the XLY and the XLP, that difference of 4%, was the 9th worst day for consumer stocks in 16 years. The 9th worst. Would you like to know what the 8 worst were part of? The other 8 days that were worse than this one were all in all but one was in a bear market, was during a bear market. The other one was during a correction where the market went down at least 10%. Now remember, this occurred at the top. This started on Friday the 21st. And remember, the close on the 19th, just a little more than 24 hours earlier, that was when the S&P closed at 61.44, which was its all-time high until this past Friday, until yesterday. So 61.44 is the all-time high, and we are getting a signal right at the beginning of this cyclical bear market. We had a signal that said, this is not good, folks. And so I saw it, I researched it, and I wrote about it. And I said, we've topped. There's no reason for this kind of rotation if Wall Street believes the market's going higher. This is mass exodus out of aggressive risk on areas and mass entrance into risk off or defensive areas. And like I said, there's no better telltale sign, in my opinion, of the stock market than what goes on between the XLY and the XLP in consumer stocks. Because again, consumer stocks, consumer spending represents 2/3 of our GDP, gross domestic product. So anyhow, again, I don't know how I could have been much more timely. I mean, the action happened on Friday, literally just over 24 hours after we set an all-time high in the market. So that's the type of information that we provide at Earnings Beats. Now, here's April 13th. This was, what, 4 or 5 days, I guess, after the market bottomed. And I said, the bottom is here, or it's rapidly approaching. Now, I want you to think and count on your hands the number of people that told you back in February 23rd, February 21st, so I wrote the article as of the 21st, 2 days after the market topped, who told you the market had topped? And did that same person tell you that within a week of the bottom that we had either bottomed or were rapidly approaching a bottom? I mean, I got an email I'm going to show you in just a minute, what we sent to our members. But this is what I wrote about and showed the S&P breaking down. And there's the VIX. Thought there was one other chart on here that I wanted to show you. Well, this is one that I'll talk about later. But just so you don't think I'm using hindsight and calling something from 2 months ago that I didn't call at the moment, the University of Michigan Consumer Sentiment came out back in April, and it was near an all-time low. And that was treated, I mean, when that news came out, the market sold off. And everybody thought, oh my gosh, this is horrible. Well, I'll talk about this in a little bit, but I just want you to notice that when you set these all-time lows, or when you start setting lows in sentiment, think about it for a second. If the consumer sentiment is already at a low, don't you think those folks have sold? I mean, I look at this and I say, well, there's only one way, but the only way is up at this point. I mean, if we're talking about being at a 50-year sentiment low, don't we just, for the most part, have the upside to think about? What you're going to find is that when sentiment is at its worst, the stock market's probably at or near a major low. And that's when you want to be buying. One of the more interesting things, and again, I'll show this chart later, but consumer sentiment, when it was at its highest, beginning of 2000, right before we went 12 years without setting another new high in the market. So we don't want to wait until consumer sentiment tells us that everything's great. At that point, we're way late to the ball game. You got to think opposite. You got to think contrarian when you're talking about sentiment. It doesn't make sense when you first think about it. You're like, oh, everybody thinks horribly. The market's going down. I mean, if everybody's bearish and everybody thinks that everything in the economy stinks, we're going to go lower. Well, by the time you get to that point, remember the stock market's looking ahead. It's looking at where we're going to be 6 to 9 months from now. Consumer sentiment is based on what's been happening. It's driving our sentiment, our emotions, our psychology down into the gutter. It's from everything that's happened that's been beating us over the head with all the headlines. Usually when consumer sentiment hits that bottom, the worst is already priced in. Anyway, talked about a lot of things in that article, but I just wanted to point it out. That's April 13th, pretty darn close to the low. Now, on April 18th, a few days later, I said, this is the group to watch for the next bull market phase and to separate noise from reality. Now, I went in here and one group. I mean, if I have to pick one group that I want to see do well, it's semiconductors. Semiconductors are in everything in our life. So when the semiconductors are doing well, or when they start to perform well, it's usually a great signal about our economy down the road. So I pulled up this chart. I showed semiconductors. By the way, semiconductors on April 18th, this index, the Dow Jones, well, let me go down here. Dow Jones US Semiconductor Index, DJUSSC, relative to the S&P 500, you can see it had really struggled over almost a 1-year period. After topping in June of 2024, we rolled back, or maybe it was May 2024, we rolled over, right? And here was the S&P 500, and down below, this is the semiconductors relative to the S&P 500. And look at the relative weakness. We topped, here was the relative top back in June of 2024, but look at the relative performance as the market was going down. And that's what you expect. And by the way, look at the relative performance from the beginning of the year to February 19th. So as the market was still trying to go higher and higher and set that final high, look at money rotating out of one of the most influential groups in the market. What was Wall Street doing at the high? They were getting out of semiconductor stocks. How do I know that? Well, they're underperforming the S&P 500. Somebody was getting out. I'm assuming it was Wall Street because they certainly weren't telling anybody else. But on a relative basis, and then as the market fell apart, look at what led to the downside, semiconductors. Now, what I was looking for was this break. And I even made a comment, I think, down here. Here was my conclusion. So it stands to reason that if the S&P 500 can clear key price resistance at 55.21 and this relative strength line breaks above this downtrend, then I'd say the bottom is confirmed. I'd keep an eye on this chart moving forward. Now, when I clicked on this chart, I think we got it right here. Here's the update. So look at what happened at the end of April when we went through 5,500 that I talked about. So even if you didn't get in at the bottom, here was what I consider to be a major confirmation. S&P getting back through 5,500, taking out this prior low. So that was the first key resistance to get through, which we took out, again, late April. And then early May, this trend line was broken. And folks, you didn't have to wait until Friday, yesterday, to get in. Semiconductors broke this downtrend line back at the beginning of May. It's been 2 months of massive gains in semiconductors. And the chart was right there. I mean, I'm pointed it out. I couldn't have pointed it out any more clearly. If you wanted to be in semiconductors, the breakout on that relative downtrend line was the time, along with a breakout above 5,500 on the S&P 500. Now, even if you got in then, even if you weren't convinced back in April and you're still scared, a lot of headlines, the tariffs, everything, it was horrible. Inflation, Fed's going to, they no longer were cutting rates and kept talking hawkishly going forward. And they're worried about inflation because of the tariffs. And that was in the news. That's what everybody was focused on, unfortunately, because if they had been focused on what was really happening, they would have seen that money was rotating over into very aggressive areas. This is how Wall Street lines their pockets before the news starts to improve. I mean, this is the way the market works. You can like it or not like it. You can agree with me or disagree with me. I'm telling you, I've researched the market for many, many years, and I'm starting to get really good at seeing these pictures develop before they actually develop. It reminds me of a line from a movie, Sixth Sense. If you ever saw Sixth Sense, and remember Bruce Willis was talking to the little kid, and he said, "I can see ghosts," and or something along those lines. I might be paraphrasing, but I think he said something along the lines as "I can see ghosts." And sometimes when I look at the market, I can see bear markets before they happen. I mean, I can just feel them. I can see them coming. Maybe corrections, maybe bear markets isn't the right word, because a lot of times I see, I don't look for Wall Street, the big Wall Street firms, to get out in front of a 10% correction. I expect them to get out in front of something that's a little deeper than that, because Wall Street firms can't trade like you and me. They can't put in a market order to sell 1 million shares of Apple, on a Tuesday, and then the following Thursday say, "Oh, I'm going to get back into Apple. Let me get those 1 million shares back." The market's not liquid enough. You can't do that. When these big firms want to buy and sell, they have to go through market makers, and they rely on market makers to get them the best possible price. That is the mandate for market makers. They have institutional clients, and what they promise those institutional clients is that they're going to get them the best possible price. And do you know what that means for you and me? It means we're about to get screwed. Sorry to put it so bluntly, but that's how Wall Street does it. That's how they get out at the top, and that's how they get in at the bottom. They use all of the fear and the panic that's driving us to talk politically and to accuse this and that and whatever, while they are under the scene, behind the scenes, beneath the surface, whatever you want to call it, accumulating. And I'll show you that accumulation and how it takes place a little bit later in the show. But these are all signs of things that I talked about before they happened. So I'm not coming in now and saying, oh, look at what semiconductors did 2 months ago. I wrote about it at the time. Now I'm going to show you a couple of emails. These were things that actually went out to our members. Now this is on Wednesday, April 9th. I think this was the market low. Maybe it was the 8th. But I talked about the past few days have been absolutely dizzying. Since the tariff announcement the prior Wednesday after the market close, here have been the S&P 500 daily returns. Thursday, April 3rd. Let me see if I can bring this up a little bit there. Maybe you can see it a little bit better now. Thursday, April 3rd, minus 4.84%. Friday, April 4th, minus 5.97%. And then you can see the massive ranges on Monday, the 7th, Tuesday, the 8th, and then Wednesday, the 9th. Another trading range, 474 points from high to low. Crazy volatility. And I said, folks, this is absolutely insane. I said, you can make annual returns daily, but you can also lose annual returns daily. I mean, it's crazy how much you can make. Now, I talked about here, I said, I did mention that trading the IWM or even possibly the 3 times leveraged ETF, the TNA, made sense with tight stops as we were potentially setting a double bottom versus Monday's intraday low. So I talked about buying the IWM at 173, went up to 190. I talked about getting back out into cash because I didn't want to hold overnight, the crazy volatility, the gaps and everything. But here was a key that and again, this is on April 9th, right when the bottoms, when all the craziness was going on. I said, in my retirement accounts, I have been accumulating after opening gap downs and morning selling to take advantage of what I believe will ultimately be a return to all-time highs later this year or possibly in 2026. I'll try to exercise much more patience in retirement accounts. So essentially what I was saying is that if you don't want to follow this craziness, it's time to start putting money into the stock market. That was on April 9th. Now I'm going to show you the next email, which was April 11th. Now keep in mind, this is a reminder for many of the Earnings Beats members. For those of you they're not familiar, obviously you wouldn't know this, but I had a family passing on April the 6th. So as far as the timing goes, couldn't have been worse. I was down in Florida. Really, I was trying to look at the market from time to time, but really didn't have a whole lot of time to concentrate on it. So I was either doing a really quick market report, or in this case, on April 11th, John Hopkins did the report. And it was just a quick update for everybody, what was going on in the market. But I want you, because I talked to John on the phone, I didn't have time to write anything, but I want you to look at what I told him. And he wrote this verbatim. I actually sent him a message and he copied and pasted it. So he said, with all this in mind, Tom Bowley asked me to pass along his thoughts to everyone. Here they are below. This is from me. I decided to go all in today. I still see the possibility for lower prices over the next few months, but I believe the risk of being out of the market is now greater than the risk of being in it. This morning's Michigan consumer sentiment was 50. So here we are. I'm not telling you what happened 2 months ago. I'm telling you this just came out. This morning's Michigan consumer sentiment was 50, matching the lowest level in history. Low readings between 50 and 55 have historically marked major stock market bottoms. Throw in the recent acceleration higher in the VIX to near 60. I'll bring up a chart on the VIX in a little bit. and it's still in the 40s. The spike in the put call ratio and the recent sell-off that favored aggressive sectors, and I don't need to see anything more. I have invested primarily in the QQQ and the IWM, but I've also added Mag 7 stocks as well. The manipulation worksheet, which this is going to be a big part of what I talk about a little bit later in the show. The manipulation worksheet also adds to my growing bullish feelings. Remember, I talked about this manipulation worksheet on April 11th, because that's when the manipulation was at its biggest, meaning that while everything was going down and we were all panicking, pointing fingers at politically and everywhere else, anything else, the Fed, the tariffs, the inflation, interest rates, whatever we could point at, possibility of a recession, everybody scared out of their mind. Manipulation was showing, my spreadsheet was showing Wall Street was accumulating through all of that. And I mean, it's despicable, but it's the way the market works. And we either learn it and we understand it and we profit from it, or we stick our head in the sand and keep calling names, people names about what's going on in the news. Follow the charts. I mean, here it is. I mean, right in the midst of all the chaos and turmoil and volatility, I'm saying get all in. I don't know how I could be any clearer. That line right there, I don't know how I could write it any clearer. I decided to go all in today. And I've been telling members ever since. You want to be long. You don't want to be short. And it's hard to get over that emotional hurdle because everything you're reading and seeing is so negative. But that's when you want to be in the market. That's how you catch bottoms. The biggest moves in secular bull markets is coming out of cyclical bear markets. So the big long-term bull markets, the best time to get in is when you have the short period of weakness where you go down 10 or even 20% and you have a cyclical bear market. I've said for the last dozen years that the bear market of 2018 with the trade war, the pandemic, where we dropped 38% on the S&P 500 in 4 weeks, the 2022 cyclical bear market that was as a result of the inflation jump, and then again in 2025. All 4 of these, I have said, they're cyclical bear markets. We're going back to all-time highs. And Friday just proved me correct for the 4th time. We went back to all-time highs. The bear market's behind us. And so part of that is long-term perspective, which I'm going to talk about here in just a minute. But I wanted to bring this up because to me, being able to make these calls is worth your weight in gold. Calling tops before the market tops or at market highs, and then calling bottoms at market lows, that stuff's golden. And you might say, well, yeah, but anybody can, you got it lucky. Well, I mean, our most watched video ever, I'm calling the bottom in the S&P 500. This was June 17th, 2022. Go back and look at the chart. From June 17th, 2022, up until right before the Jackson Hole speech that the Fed had on August 26th, I think it was sometime in mid-August, we went up 700 points on the S&P 500 after I made this call over about a 6-7 week period. So we're getting really good at seeing all the manipulation. I talked about manipulation in this video. You can go back and watch this. But again, we've had a history of making these calls. And again, members, feel free to post anything you want on here. If I'm saying something out of line, you've been a member for a while, and call me out if I've said anything that's not true. Anyway, let's talk about perspective, because perspective is really big here. And I want to go through some of these topping charts. We're going to talk perspective, and then I want to talk a little bit about topping signals. And then maybe we'll take a little bit of a break. But for now, here's the long-term chart. I don't know how else, I talked about a 100-year chart earlier in one of the articles. Don't want to spend a lot of time. The only thing I want to point out is that we go through these grand super cycles. And we are in what I believe is probably a 20-year secular bull market. And we're in year 11 or 12 right now. So we're probably in about the 5th inning of a 9-inning game. And as far as I'm concerned, when I look at the potential of the secular bull market, we had a secular bull market through the 1950s and 1960s, 20 years. We had a secular bear market where we went sideways, mostly a lot of down, but also some up. But we didn't set another new high for about 13 years, 12, 13 years. That's the definition of a secular bear market. We broke out in the 80s. What did we have in the 80s and 90s? Secular bull market, 20 years. Now, you go back in the 50s and 60s and 80s and 90s, and you'll see cyclical bear markets. Remember the crash of 1987? That was when I started learning my first lessons in the market. I remember my account was chopped in half. And literally it was like in the course of a week or 10 days. I think that was Black Monday where the Dow Jones dropped 25% in one day. I mean, we've had cyclical bear markets within cyclical bear markets within secular bull markets. Happens fairly frequently, although I got to really give our Fed a hand because this Fed has been overseeing 4 cyclical bear markets in 7 years. And I personally think that they are as responsible for these bear markets as anyone. Not that I'm not saying that the market wouldn't have had its ups and downs and that we haven't had some issues. I'm just saying them being late to the party caused a lot more pain in the stock market from time to time than it should have. Why have we not had 7 or 4 cyclical bear markets in any other 7-year period? Personally, I think the Fed back then did a better job of kind of maneuvering us through rough seas. This one has struggled, and they are continuing to struggle because Fed Chief Powell's on the wrong side. I'm not going to, if you know me, you know I'm not a fan of Powell. I get more and more tired of him every day. Some people like to say, "Oh, you must be a Trumper. You know, you don't like Powell." Well, I didn't like Powell when Biden was president. So I don't know. Call it what you want. I don't get into the politics. I look at what the Fed is doing, what they're saying, and I look at the charts, and Wall Street is saying something completely different. Money is pouring into semiconductors, software, and all these other growth areas in the market right now. You don't do that when inflation's about to rear its ugly head. If you need to understand what happens to growth stocks as you approach an inflationary period, go back and look at the end of 2021 and throughout 2022 when stocks got bludgeoned. These growth stocks got hammered. Folks, money is rotating into these stocks right now as we set new highs. Wall Street could care less about inflation. There's no inflation. There's not going to be a problem with inflation. Why is the 10-year Treasury yield at an 8-week low? Down at 4.25% or wherever it is right now. Boy, a lot of inflation expectations being built into that, right? That's sarcasm, by the way. All the markets are telling us there's no inflation problem. The only one thinking there's an inflation problem, unfortunately, is the head of the Fed. And anybody who likes to read articles and react to articles, because there's a lot of negative articles that'll talk about it. We had tariffs in 2018. I never saw any inflation. Remember at the end of 2018, Fed Chief Powell said we're going to have 2 rate hikes in 2019. He said that in the fourth quarter of 2018, the market tanked. I wrote on December, I'm pretty sure it was on December 26th, and I said, we're not going to have any rate hikes. Market was telling me we weren't going to have rate hikes. There was no inflation problem. What happened? What was the next Fed move? I believe it was in June of 2019. They cut rates. They didn't hike. They cut. He said they were going to hike twice. He got it wrong again. He's had a history of getting it wrong. He thinks we got an inflation problem. He's getting it wrong. We don't have an inflation problem. In fact, I just made the bold call. I think we're going to get a rate cut in July. One of the few. Let's see what happens. I think momentum's going to build, and I think we're going to get a rate cut in July. We'll see what happens. But again, big picture, folks, we're in a secular bull market. So you got to be thinking long-term, we're going higher. If we see issues, we got to be thinking that they're going to be short-term in nature, use history and try and figure out where we might go. So that's what we're going to do. Here is a channel of the S&P 500 over the last 16 years. Now, during long-term, let's go back to this 100-year chart. You can see that if I connect the lows, you'll see they got a pretty nice trend line that goes 100 years. Now, this trend line is pretty, the slope isn't that great. It's probably like 8 or 9% because that's what we've averaged going up over the last 75 years. I know we've averaged going up 9% a year since 1950 on the S&P 500. But when you get into secular bull markets, you can see the channel it turns up. The slope goes up. You make more money during secular bull markets on average. So I think this one was like 14 or 15% a year. This one back here, I think, was about 11% a year. And I think right now we're probably at around 12.5, 13% a year. So we're doing better than the average. And you can see the slope of the channel to the upside is moving away from the trend line. That's what happens during secular bull markets. We move away from this, the bottom of this trend line. And during secular bear markets, we come back down and we test it. See how we tested it in 74, 75? See how we tested it at the low in 2009? At some point, we're going to hit a secular bear market low, probably in 10, 15 years. And we're going to come back down and test this line, I believe. But we got a lot of upside before that. I wouldn't be getting out of the market now because something might happen in 2038 or 2036. So I'm going to stick with the long side. I think we got a number of years still to go. So anyway, I just wanted to show you. So this is the channel just for during this current secular bull market. And some people say, well, the secular bull market started in 2009. And using perfect hindsight, I agree. That's when it started. But did you know in 2009 it was starting? No. So I use, when we get the breakout, we get a double top breakout above that 1550 area. That happened in April 2013. To me, that's the secular bull market. That's the start of it. And if you connect the highs and you connect the lows, we got this nice little channel. And then like on a 2-lane highway, you kind of got the dotted line in between the two. That's kind of the halfway point. And notice during these cyclical bear markets, where do we tend to pull back to? Right about that center dotted line. Where did we just pull back to in 2025? Went back down, had on a weekly basis, we never closed below 5,000. So we got right down to that dotted line. Beautiful bounce right off of it. So anytime you get down here, and that was part of what I was talking about when I said I'm all in, that the risks of being on the short side now outweigh the risk of being on the long side because we've already had a big drop. We're now back down to an area on this channel where historically we bounce, and a lot of times we bounce hard. So what did we do? We just bounced hard. We did it again. So did I know that we weren't going to go to 4,500? No, I didn't know that. We could have gone down and tested this line. We could have fallen apart, maybe go to 2,000, 1,000. I don't know. Anything can happen. We got to play the odds. We're in an uptrend. We still got historically low interest rates in play. I mean, the economy's not that bad, but you get so focused on the day-to-day news and the name calling and everything else, and you just can't see for the life of you how the market could go higher. And now all of a sudden, we're going to go into earnings season. You're going to see earnings explode on a lot of these growth companies, and you're going to be like, oh, everything's fine. Well, the time to say everything was fine was when your hair was on fire back in April. And it's not easy to do that when your hair is on fire. All right, let's talk a little bit about, some of these topping signals. So S&P 500 going up. Here's the QQQ versus the spider. I like to look at this ratio because the QQQ is more technology laden than the spider. They're both heavily invested in technology stocks. QQQ is about 50% in technology. The spider is only about 31% in technology. So if you look at the ratio, you're looking at something that's more growth oriented versus something that maybe is a little bit less growth oriented or more value oriented, however you want to look at it. But one of the things that drives the stock market is risk on versus risk off. So when the QQQ is outperforming the S&P 500, when this ratio line is going up, it's telling us that we are in risk on mode. And a lot of times when you come off of lows and out of bear markets, look at how the risk on soars. Here, coming out of October, well, we hit a low actually right at the end of 2022. But this is where all the money's to be made in these growth names. You've got to see it at the bottom or close to the bottom because that's where you're going to make the most money. As you get higher and higher, yeah, the QQQ might outperform the spider here and there, but you can see we've kind of just been going sideways here for the last couple of years. Although on Friday, you can see we're kind of making this move to the upside. Looks like we're about ready to make another breakout, which would fully support this move to the upside in the S&P 500. Now, down here at the bottom, I have a correlation coefficient on stock charts. What this does is over a number of periods, and the default is 20 periods. This is a weekly chart. So over 20-week periods, this correlation coefficient looks at what's going on in the S&P 500 and looks at what's going on in this ratio. And it says, is it positively correlated? Are they going together? Or are they negatively correlated where one's going up and the other one's going down? Anything that's above 0 is positive correlation. If you get above 0.5, 1 is the limit. I mean, if you get up to 1, it means literally over 20 period, over the 20 periods you're looking at, they're going hand in hand in the same direction. It could be to the upside, it could be to the downside, but they're going hand in hand. When you get anything down here in this red shaded area, that's minus 0.5, which is inverse correlation. It means that one's going this way and the other's going this way. Well, you can see from the blue shaded area, we spend a lot of time up there. So what this tells us is that the QQQ versus a spider, the directional move, that versus the S&P 500 is really important because they tend to go in the same direction. So when you see the S&P 500 going up, you really want to see this going up as well. And if you look since April, beginning of April, we're going straight up in the S&P and we're going straight up in this ratio. Look at what was happening back at the end of 2021. S&P was going up. We couldn't make the breakout. And in fact, we rolled over in November and started going down all the way till that high at the beginning of January. See how we started rolling over? And then as we started moving lower, we just broke down. Look again, as we go up here to the top in February, we basically could not get back up to those prior highs, and we rolled over. Now we're coming back up. And I'll show this a little bit more clearly on some other charts as we keep moving forward. Actually, let me get rid of some of these prior charts and things that we were using, just because it's a little easier for me to manage. Okay, so now we're at next chart where I want to show you the XLY XLP ratio. Now this to me is like my favorite ratio in the market. I always follow the XLY XLP. I look at it every day. I don't make calls based on it every day, but I look at it every day. It's out there. It's consumer stocks, so I really want to kind of get a sense. We saw discretionary explode late on Friday, which was awesome. And you can see here, XLY XLP, even though we're at a lower high from where we were, this ratio is going straight up right now to support this move to the upside. We don't know where it's going to end. We just know it's moving straight up. So we'll be watching it and see where it ends. But my feeling is we're gonna move up and break out probably to all-time highs later this year or next year on this XLY XLP ratio. But right now it is moving up and it's fully supporting this advance. And again, I use the same thing like I did with the QQQ and the spider. Use the correlation at the bottom. You can see how often we are in positive correlation, meaning the XLY XLP and the S&P are going in the same direction. Look, right now we're almost near 1. That's what I was saying. We're going straight up in this ratio and we're going straight up in the S&P 500. That is always a good sign. But how much time in the last 10 years have we been in serious inverse correlation? I mean, I see none where we're actually into this red shaded area. A couple of times we've gotten close. But look at all the times we've spent above 0.5. I mean, if there's one ratio to really add to your arsenal when you're evaluating the market, it's this one. When the market's going up and this ratio is going up, I call these my sustainability ratios. This is what I believe sustains bull markets. So when we're going up, the ratios are going up, I believe the rally is sustainable, meaning we're going to have pullbacks from time to time. That's all it's going to be, a short pullback, and then we're going to go higher again. Now, this is an intraday chart. This is a user-defined index. So what I've done, remember when I showed you the XLY, XLP intraday and how that helped me call the top? That was the article I wrote back on February 23rd. Remember, XLY was going straight down, XLP was going straight up. That occurred when? February 21st of 2025. Right here. Because this is an intraday. This ignores gaps. So this is only looking at what's going on during the trading session. From opening bell to closing bell. Anything that happened before the market opened, not paying any attention to. So those huge, massive gap downs at the opens, this doesn't pay any attention to it. This middle panel does. So in February and March, I mean, we were seeing the XLY, XLP, going down on both, using both methods. But this is where we really started to fall apart in February, intraday. And that led us, of course, in the S&P 500 to that cyclical bear market that we saw. That was the confirmation of all the other signals that I had talked about prior. Now, where do we stand right now? Well, we've been going up. Look where we bottomed in this, by the way. March 15th, intraday, money started rotating back towards discretionary about 3 weeks before the bottom. Now, you think that was a coincidence? Look back in 2022. Remember when I said I called the bottom when the S&P hit this low in June? I showed you that video over on YouTube. I'm calling the bottom June 17th. Here was the bottom June 17th. Look at what was going on here. This is the intraday XLY, XLP. We bottomed in May. We had a double bottom in May. By the time we hit this low in June, look at the money rotating back toward discretionary. Money's rotating into an aggressive area. Why would that be? We're going down. We're putting in a new low in June, and this is the Great Depression 2.0. Remember? Market was going to collapse. Well, folks, the market was already down 20%. And Wall Street was starting to show signs of accumulation. Even when the S&P went down to a new low in October, look at what was going on in the intraday. Now, we did have one more swoop in the fourth quarter, but we never put in a new low, and we ended up rallying back off of it. Anyhow, a lot of great information. All right, how about these ratios? Now, I'm going to show you 2021 S&P 500 right here, putting in its final high. Now, these are some of the sustainability ratios. A couple of them I just talked about. Here's the QQQ versus Spider. So the S&P goes up, QQQ Spider going down. Discretionary versus staples going down at that last high. Growth versus value. Large cap growth versus large cap value going down. This is another large cap growth versus large cap value going down. Mid cap growth versus mid cap value going down. A small cap growth versus small cap value going down. Transportation versus utilities going down. And copper versus gold going down. All of those are risk-on types of ratios. They were all going down when the S&P set the final high. S&P was going up, but it wasn't being led by any of the risk-on areas. That is a massive, and I'm not talking about one piece of evidence. This is a lot of jigsaw puzzle pieces putting together. They're all rolling over. And what happened after that? We got killed. I went to Market Vision 2022 that year, the first Saturday in January, and I said, I thought we were going to have a bear market. I thought we were going to go down 20 to 25% over 3 to 6 months. I said it first weekend of January 2022. Where did we go? By the time we hit the low in June, within 6 months, we were down between 20 and 25%. That's a pretty bold call to make before it happened. But the signals are being given to us. Wall Street tells us we can't time the market. I say BS. We can time the market. They don't want us to time the market. Why? So they can get out. This is the biggest conflict of interest in the history of histories. Wall Street, the big Wall Street firms, they've got tons of capital that they invest for themselves. They've got tons of capital from very, very wealthy clients who pay their bills and they invest for them. I'm not one of those. I'm not one of those elite. Most of you probably are not as well. So we're left out to do things on our own. While Wall Street is managing their own money and their wealthy clients' money, then they're sending analysts on to CNBC and all these other stations, media. They call them analysts. I call them influencers. They're going out there telling us what's going on in the market. Oh, market's going down. Oh, no, things are really going to get bad. Blah, blah, blah. Or things are really going to get good. I can promise you on first week of January, they weren't telling you the market was topping. They probably were telling you how awful things were in May and June. Oh my gosh, this is bad. We're lowering our target. You think they don't lower targets when the market's going down? John Hopkins, my partner's keeping track of it. What's the guy, Mike Wilson or whatever from Morgan Stanley? Right in the middle of the biggest dive back in March and April, he lowered his target on the S&P 500 from 6,500 down to about 5,500 after everything got obliterated. So now he's getting more defensive. Do you know what he just did recently? Now that the market's back up near highs, he raised his target back up to 6,500. Folks, we just get manipulated. And Wall Street's got a perfect scheme for it. They invest ahead of time, rotate, get in and out of stuff before they tell us. Then they've got all their influencers going into media telling us what to buy and what not to buy and how bad the market is over here and what you need to avoid, blah, blah, blah. And then guess what? After they tell us all those things to do and that the market's awful and you really want to get out of technology names, then their market making unit is actually buying technology names. And you can see it in the AD lines. You can see it in the manipulation. What a great scam they got going. And you know what? It's legal. I call it legalized thievery because they're stealing from everybody else. At the bottoms, everybody else wants to jump out a window. Wall Street's accumulating. And then by the time most folks realize that, hey, things aren't as bad as we thought, we're back at all-time highs. So you get panicked out at the lows and you got to jump back in at the highs. Rinse and repeat. This is what happens in Wall Street. Every few years or every several years, get the negative divergences, which I'll show you in a minute, get all this negative rotation, this bearish rotation at the tops, and then they steal our money. They get out. All of a sudden, once they get out, then the market just goes boom, 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 boom. There's no stopping it to the downside. And then we rally back up. Now look at what just happened. Now that was back in 2021, the end of 2021. You want to see what happened in February of 2025? You want to know why I was calling tops? Do you want to know why I said I went cash at the end of January? Do you want to know why we ended our portfolios 3 weeks before they were due? Back in January 31st, we went cash in all of our portfolios. You want to know why? S&P 500 going up. QQQ Spider down. Discretionary versus staples falling off a cliff. Russell 2000 growth versus value. This is large cap growth versus large cap value. Rolling over. Large cap growth versus large cap value, a different index, rolling over. Mid cap growth versus mid cap value. Just getting crushed. Small cap growth versus small cap value. Down. Transportation versus utilities, down. The only one that really didn't do anything to the downside, actually started going up, was copper versus gold. And that one took a hit later. Do you not see the exact same thing that we talked about back at the end of 2021? Do research. This is what we do at Earnings Beats. We do our research. Now look at what's happening. So I'm getting emails. People are writing in, well, Tom, we're back at the highs, but this ratio doesn't quite look like it did a week or two ago. It's starting. All right, let's take a look at these ratios. And off the bottom, here's the S&P 500 up. Here, look at the ratios now. You see anything rolling over? Up, 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 up. Even copper gold starting to turn up again. Everything's up. All of our risk on is supporting this move to the upside. You want to bet on a bear market second half of 2025? You go right ahead. I will see you at the end of the year. Let's talk about it. Market's going higher. Fed's going to be done. They're going to cut. Then we're going to, all of a sudden, everything's going to be fine. Earnings are exploding and rates are coming down. Let me tell you something, folks. I was in public accounting for 20 years before I got into this business. I did valuations. Two things drive valuations: expanding multiples to the upside. In other words, growth picking up, and lower interest rates. As soon as rates come down, valuations go up because all future earnings are being discounted back using the current rate of interest. As rates drop, it makes all of those future earnings more valuable. If you were going to buy a company and this company is saying, okay, this is our earnings for this year, this is going to be our earnings for the next couple of years, and you're trying to figure out a multiple of what you want to buy, if interest rates are at 10% versus 5%, that revenue stream is much, much more valuable to you. And that earnings stream, cash flow stream, whatever you want to look at it, is much more valuable to you in a 5% interest environment than it is in a 10% interest environment. You're going to pay more. So, and those are the two things we've got coming. We got rate cuts coming. I'm convinced of that. And I think we could get the first one in July. We'll see. That's a bold call. Nobody's really expecting that, but I would not be surprised. I'm beginning to believe we're going to get one. And then the economy. Why is money rotating in all these growth stocks? Why do you think Wall Street wants into these growth stocks? You think it's because we're going to have a recession down the road and the earnings are going to contract? You think it's because inflation is going to eat away at those earnings? You think it's going to be inflation? That's why they're going to get into growth right now? That's why all of these risk-on ratios are going higher? No, they're going higher because earnings are going to go up, multiples are going to expand, and interest rates are going to come down. Nirvana for stocks. That's why they're going up. That's why Wall Street has been manipulating everybody since back in March, getting in March and April while everybody else was jumping out. And now, you know what's happening now? When was the last time you saw a big gap down at the opening bell? Wall Street's in. They don't need to accumulate. They don't need those gap downs anymore. Now, all of a sudden, we're getting gap ups. You know what's happening? Individual investors that have to get back in are now seeing gap ups almost every morning. And now they've got to chase to get back into the upside. Wall Street's not going to wait for you. They're in. They got in back in March and April. All right, just a couple more charts and we're going to take a break. Put call ratio. This is a 5-day moving average, so it's kind of a short-term kind of a signal. But I just wanted to show you that toward the end of 2024, we're starting to get a lot more 5-day readings that were very low, meaning that the market was much, much more complacent. And anytime the market gets really complacent, that also can be a problem. And so that was a little bit of what also was leading to our call in January and February to be careful, as was the fact that the best time to be in the stock market, when we have the absolute best performance, is the October 28th, or actually October 27th close through the January 18th close. So once you get through that window, historically, performance tends to drop off. That's January 18th. Market topped February 19th. So once you get past that bullish window, that fourth quarter window and into the first quarter, into the first half of January until earnings season kicks in, that period tends to be very bullish. So we had just gotten through that period as well. So there's a little history that helped to make this call about a February top. A lot of things lining up. Now, this is the bigger picture equity only put call ratio that I like to use. And I just want to point out one thing on this chart. Again, this comes from a lot of research going back and taking a look at what happens. When the market is very, very fearful for an extended period of time, you get high equity only put call ratios. And eventually the 253-day moving average, which is a 1-year moving average, will peak. Coming out of 2007 and 2008, during the financial crisis and into the early part of 2009, we were panicked. so many folks were bearish. And we got the 253-day moving average up to this mountaintop. There was no room for any more bears. Folks, we were already there. Anybody who could play puts or trade puts were trading puts. Anybody that could sell the market had already sold. We were at a crazy panicked low in 2009. Remember? That top in this 253-day moving average coincided with a massive rally in the market. And if you go back and look, every one of these tops, when we're going down, market has its best performance. The 253-day moving average, once it rolls over and starts moving down, remember, it was all bears. There's no more bearishness. So it's just moving from all-time high bearishness until, it takes a couple years to get to the point where the market's complacent again. And during that period, while it's dropping, while the fear's coming out of the market goes on these huge runs. And the opposite is true. When we turn up and we start on these extended moves to the upside where fear is building, we move from being very complacent, very bullish, to a point where panic starts to set in. During that journey, look at what happens to the market. 2011, 2012, we went sideways. What happened in 2014 through 2016 while this was going up? Sideways. A little bit of correction, couple corrections, or maybe a correction in here. How about here when it was rising? That's when we had the trade war back in 2018. And, again, mostly sideways. Had some down, back up, but for the most part, we're going sideways. How about during 2021, 2022? This right here, remember I said at the beginning of 2022, I called a cyclical bear market, 20 to 25% within 3 to 6 months. When I walked in, I said this was the biggest problem. When I walked into that market vision event, first Saturday in January, I said, this is the biggest problem that the market faces in 2022. We need sentiment to reset. We were at ridiculous lows, meaning everybody was buying calls. Remember the pandemic? Remember all those meme traders? GME, and you just put money into anything and you just made money. Just buy calls, it's fine. A lot of new traders coming in thinking that Wall Street was just a printing press, ATM machine. We know how that ends. As long-term investors, we've been through those periods before. I'd seen it before. January, we had rolled over and this was just starting to turn up. And do you remember that channel chart that I showed you? Do I still have that? Yeah. Look at where we were at the end of 2021. We were outside the channel. We had a lot of room to fall back to the downside. So all of these things were coming together at the same time. It's like, could the market go up? Yes. How risky was it to hold, though? Do you really want to take that risk with everything that we were seeing? No. That's why I called a bear market before it happened. Perspective, looking at the chart, we'd just gone too far. So many signs were lining up against us. Now, 2023, look what happens. We get this double top and we roll over. What's been happening ever since? We had the cyclical bear market. We had a couple of those. We had the one in 2020. This was really quick. We had the one back in 2018, right here. Actually, no, right here. We had the 2022. We had some short-term signs that told us about the cyclical bear market. I already went over all those. But this is telling us long-term that we're still in this uptrend. And now here we are just now breaking out to another high. This isn't rocket science. It's doing research. It's following the charts. Notice I haven't pulled up a single media headline during this entire presentation. Everything I did bring up media headlines, my own, right? I showed you those, but those were based on the charts. I always give you backup to what I'm thinking. You don't have to agree with me, never have to agree with me. And we have plenty of members that'll write in and say, I just don't see it, Tom. I'm sorry. And many of those same members will write back in later and say, well, I was wrong. You saw it. I should have listened. And again, I'm not saying I'm going to be right every time, but I always have backup. I'm always going to try and educate and tell you, hey, this is why I'm seeing what I'm seeing. Now, people unknowingly see my titles on my YouTube video and they just write in, oh, he's a Trumper. Or back when it was Biden, oh, he's a Democrat. He's way out on the, way on the left side. It's like people don't even know me. People just jump to conclusions. If you support something, that must mean that you're associated with this person or that person, which is stupid. Stupid. Especially since I give all my reasons and none of them are political. But anyway, we're still going down. I don't know where I had a member write in not that long ago when we started to go down in this cyclical bear market. And I said, we're going to come back. And they're like, nope, we're not coming back because we were getting close to these levels and we're going to turn. And I'm like, well, now you're trying to anticipate. How do you know we're going to turn there? How do you know we're not going back down to where we were in 2021? We don't know. Let's get a definitive bottom here and start to turn back up again before we start to jump to conclusions. And again, that's why sometimes my signals, I give them out and then people start using them in ways that I'm like, no, I mean, we're still going down here. Fear is still, from the big picture, fear is still unwinding. At some point, this will turn back up and it might, again, I don't think that means that we're going to enter into a secular bear market, but it could mean that while we're turning back up, that maybe we do one of these numbers like we did in 2018, 19, we go sideways for a while. Or how about 2015? Who's to say we don't have an 18-month period where we go up, we go down, we go up, we go down? Maybe we're going to run to 7,500 right now. And then over the next 18 months, we just kind of go maybe to 7,700, back down to 6,900, back up to 73. I don't know. Let's see how it all plays out. But right now, that is a really bullish signal to me. Continues to say you want to be long the market. All right, transportation stocks. One thing I'll just mention here is that when transportation is not doing well, look at what the S&P 500 does up here. We're just kind of going sideways to down. S&P during this period doesn't do well. Sideways, downtrending, S&P doesn't do well. Sideways on transports, S&P doesn't do well. When does the S&P do really well? When transports are rising. S&P does great. Transports are rising. S&P does great. Transports rising. S&P does great. Transports are rising. S&P does great. Transports generally were rising up until 2025, and the S&P was doing great. Look at the downtrend that we've seen here. And I think we just broke it at this past week. I mean, transports have had a really good run here of late. But why does the S&P do well when transports are going up? Well, why transports only go up for one reason. Either the economy is stronger or it's going to get stronger, because that's the only thing that drives transports. You're going to ship more goods when you're doing more business, when the economy picks up. So when you start to see transports breaking out, a lot of times that's a good signal for the S&P 500 because it's starting to indicate economic strength ahead. So transports, this might be an early signal, but it may prove to be a very, very, very strong one. So keep an eye on the transports. Almost done here. Negative divergences. So 2021, look at those highs in terms of the price action. Weekly PPO kept coming down. And then we eventually topped at the beginning of 2022. Another indicator of slowing momentum to go along with the rotating stocks that we saw. Well, guess what? It happened again. We had the same exact setup heading into February of 2025 that we had heading into January of 2022. So we had slowing momentum to boot on top of everything else we had going. Finally, volatility index, the VIX, another sentiment indicator. Normally, what happens is the S&P goes up and the VIX goes down. Well, in December, from December to the middle part of February, S&P went up, and we actually saw the lows moving up on the VIX, which is kind of weird. And then even if you didn't think too much of that, we broke above 20 very early in this move to the downside, probably within a week of what I thought was the top. We had confirmation on the VIX going through 20. So even if you didn't see and you didn't want to get out because of all the signs I was talking about, this was another sentiment indicator. When that VIX goes through 20, I say, you want to be really careful when you're rising and you're going through 20, because many times that will be your signal that things can really start to turn ugly in the market to the downside. And once you go through 20, if this truly is a bear market, usually you don't confirm that you're out of the bear market until the VIX goes back down below 16, which is what I put this little line in here. We still haven't gone back down below it, but now we got an all-time high. So once you got an all-time high, the bear market's over. So we don't even need a VIX signal at this point. But anyway, we went down, we held around that 17 level, and then the market couldn't get through 5,800, had all those other issues in terms of risk on stocks going down, risk off stocks actually doing better. The VIX was elevated, and once we got that next breakdown, then things really accelerated to the upside. And then I talked about the VIX. When it gets near 60, you're normally getting close to a bottom. The problem is if it goes from 60 to 70, you're probably going to lose another 5 or 6% in the market. If it goes to 90 or 80, which was the high I think we had back in the financial crisis, you might see another 10% come off the market in 2 or 3 days. So that's the risk that you have in the short term. But longer term, pretty much any time you see a VIX at 50, you could be holding your nose and buying. And just understand that you might be down 10% in 3 days. But when it ultimately tops and starts to roll over, those are going to be your biggest runs back to the upside. Here is that chart on the University of Michigan consumer sentiment. Here's the all-time low that we were approaching back in April. And remember, that's what I wrote about in the email to members. And I said, everybody else is thinking this is a horrible thing and sentiment's awful. That means market's going to go down. And I'm looking at it, I'm saying, well, let's see, every time we've been down here around 50, let's see, that was a great time to buy. Here we got down to 60. That was a pretty good time to buy. Here we got down to 65. That was a great time to buy. Now here in 2008, you might have gotten a signal it was a little early and you would have had some pain. So I'll acknowledge that. That one wasn't the best signal, the first one. The next two, though, readings down around 55 were right near the market low. 2011, we got down into the 50s, right near the low. 2022, that was about June. That was the May and June when the sentiment went down. Had you bought there, you would have been very happy. Like I said, we went down one more time in October, but you buy there in June, May, June, you'd have been very happy. And then in April, when the reading came out, just buy. It's at 50, buy. So again, it's about putting all these things together. All right, I'm going to go into the manipulation in just a minute, but I did want to just point out to everybody, and John, I know you're going to talk about this a little bit, but we do have a 48-hour flash sale. I mean, we want to thank all of you for coming in here and joining us. I know, my voice is already starting to get a little hoarse. I love doing this. Hopefully you can tell. I mean, I am passionate about this stuff, and I'm really passionate about trying to teach others, because I don't like folks watching the news and deciding to make their investment decisions based on what Wall Street wants you to do. Remember, Wall Street pays CNBC and all these other media outlets millions of dollars in advertising. I mean, they're all in bed together. And so I don't know how much of this is true. Let's see if we can steal from the public, but it sure is awfully suspicious, especially when I see, these influencers over on CNBC talking about lowering their targets. At the same time, I'm seeing rotation going into growth stocks. And it's like, something just doesn't make sense. And this isn't just me. This is a ridiculous conflict of interest that we allow around our stock market. And this is how Wall Street makes billions of dollars at our expense. And it's why they're going to continue to. So you either understand this system, you understand what's going on, and you make these calls in real time when it isn't easy to pull the trigger. Let me tell you, when the market's sitting at an all-time high in February, your account balances are all great. Do you really want to put your money in cash? Probably not. You're like, hey, this is great. I want to keep going. But that's what should have done. And then what about in April when everybody's telling you the sky's falling and the tariffs, and especially if you're politically motivated and you're upset because of what Trump was doing with tariffs and everything else. Again, I didn't know, and I'm not trying to support any political party, I promise you that, but I didn't know what the heck was going to happen with tariffs and where we were going. Nobody did. But I'm sitting there looking at the charts and Wall Street's getting in. So what do I want to do? Do I want to sit back and listen to what everybody's telling me, how low the market's going to go? Or do I want to follow the billions of dollars that Wall Street's putting into stocks in March, late March and early April? And I'm going to show you those numbers in just a minute. But anyway, John, here's the flash sale. I'll pull this page up and I'll let you talk about this for a minute while I get some water.
Events. We like to reward those of you who took the time. By the way, if you like what you're hearing and seeing, make sure you hit the like button, spread the word about earnings beats. And let me tell you something. This is our 21st year in business. And I followed Tom Bowley, for many, many years. And this is an opportunity for you to save a couple $100 on membership. Normally it's $9.97 for a year. You can save $200 if you sign up. And if you sign up today by midnight, make a note of that, I will give you another month. So you end up with 13 months for $7.97. It doesn't get any better than this. Remember something else too. Tom's covering a boatload of information today, but it's unbelievable how quickly things can change. And so what you're going to find with Tom is that while he has been overall bullish and correct for many years, he won't hesitate to let members know that something's shifting. And that's the value of a membership. These are great events. You get a lot of information, but if you're actually trading or investing long-term, you want to have Tom on your team. Every single day, he'll give you a daily market report. Every Monday, he gives you a weekly report. And what's really important about this particular sale and becoming an annual member, Monday, Tom is going to have his quarterly market update. We had one in January for the year. We had one in April, and now we're having this one for the next quarter. And he's going to cover exactly what he sees developing for this next quarter. Potential highs, potential lows. And then finally, I want to mention, in about a month, Tom's going to have what we call our earnings webinar. And that's when he starts looking at all the companies that are reporting earnings in July, some of them that are coming up to report, the ones that look like they could do well, maybe pull back, just an unbelievable amount of information. Sign up for this today. By midnight, you'll save $200. By the way, 95% of our members are annual. You can sign up for a monthly membership. It'll cost you $147 a month and a lot more over the year. If it's even something you're remotely thinking about, just do it. Save the money. Get an extra bonus if you sign up by midnight tonight. I'll make sure Matt adds that so you have 13 months at the reduced price. Strongly encourage you to do that. That's what I wanted to say, Tom.
Okay. Yeah, take us up on the deal. Think
especially
about
with Monday's event.
What's that?
Especially the Monday of, just so people know, our Monday event is for our annual members only. And the other thing I want to mention, when we have chart list, when Tom does a presentation, that's an exclusive benefit for annual members as well. But you really want to be on the Monday event because Tom's covering a lot of things that he saw developing and how they worked out just like he thought they would. He's going to be talking about what to watch for, both positive, negative potential signs in the next quarter coming up. And if you're an annual member, you get to come into that event.
Yes, absolutely. And I love your support on YouTube, and I love your support, over at Stock Charts and with the things that we do for free and all. And you definitely can help us by hitting that like button and subscribing to our channel. Those are things that really drive metrics on YouTube and can help us. So definitely, if you can do us a favor there, that would certainly support us. But nothing supports us more than becoming an actual paid member. I mean, we have a small team here at Earnings Beats, but we do a lot of really great work. Everybody here is deserving of the money they make. And, I just hope that you feel after watching this that we always have our members' best interest in mind.
Yeah.
Um,
And by the way, Tom, this flash sale, it's right on their website.
Yeah.
Okay.
Yep.
So that's like, okay, great.
Yeah. Flash sales on the website. And, right now on your screen, you can use that QR code you can scan with your phone. That'll take you to the landing page on your phone for those of you with a
By the way, I see somebody in the chat asking what's included. Just go to click on the link and you'll see everything that's included. It's just a mind-boggling amount of great information.
Yep.
Okay, I'm out.
Okay, sounds good. And there's what you got on the website. That's what you'll see if you click on the link on our homepage. So I just want to say, $797 for 12 months, 13 if you sign up today. What are you talking about? 60 or $65 a month? And you go back and you look at some of these real-time calls and some of the things we've done for our members, on April 11th saying, hey, I'm 100% in. I'm all in. I mean, I don't know what the value is on that. But if you're managing your 401k and you've got thousands of dollars, maybe even hundreds of thousands of dollars, some of you may have in the millions. I mean, we're talking $60. It's probably the best value we're ever going to get. So what I would suggest is that, hey, give us a shot, 1 year. I know one thing, we got some very, very loyal members that have been with us for many, many years, and they probably think that we're way too cheap based on what we've done for them over in the past. Only thing I ask for you to do is give us a shot. Next year is going to be really important. Where do we go from here? We just set an all-time high. This is a great time to try us out. And it's going to start on Monday. Like John said, I'm going to give you my forecast for the next 90 days. So Q3 update. And I think that, what we're going to have to say then and then throughout the balance of this year and into 2026, things can change. I could be really bullish right now. And by the time the end of the year rolls around, a lot of signals could change. I might go into 2026 saying, hey, let's get back into cash again. I don't know where we're going to be. But my point is, if you have a year of us, it's almost like having a little bit of insurance. I can only promise you that I'm going to be objective. And again, a lot of people like to name call and label me. And that's fine if that's what you want to do. But I honestly don't care about a lot of things that go on in the media. I don't care about politics. I care to some degree about politics, but I keep it to myself. I'm not somebody who believes that my opinion of politics matters to anyone else. I have one vote just like everybody else. I'm not going to be somebody that's going to throw my political beliefs around. My dad taught me that when I was about this high, 3 years old. Don't talk politics, don't talk religion, and I don't. So anyway, if you just want somebody who's unbiased, who's going to look at the charts, I'm going to tell you what I think. Am I going to be right every time? I don't think so. But at the same time, we've had pretty darn good track record. And I think the stuff that we look at just makes sense. It's about evaluating risk. It's not about being guaranteed that you're right every single time. And I think we're really good about assessing risk in the market. Anyhow, be sure to check that out. So let me get back over now, and I'm going to pull up. Let me pull up first a chart I want to show you from 2022. I'm still on the screen here, so hold on. I think I've still got you. So let's take a look. This was 2022, and if you've been here before with Earnings Beats, you've probably seen this. But I believe the market goes through phases. And I kind of started to figure this out during the pandemic about trying to see what was going on underneath the surface of the market, or using intraday trading behaviors to try to figure out exactly what phase the market was in. And so in 2020, during the pandemic, during those 4 weeks, we had this huge drop, in the number of COVID cases, as it was exploding. And, the news was just horrible. First, we saw a lot of selling. And then as things really started picking up, cases around the world were picking up, we started seeing massive gap downs in the market. But we were also starting to see some big recoveries. And I started seeing back then the importance of the AD line, the accumulation distribution line, not the advanced decline. Sometimes I say AD and people get it confused. accumulation distribution. The accumulation distribution is a lot like the on balance volume, except on balance volume includes the gap. So on balance volume, if you're pulling that up, let me go into a chart here. And let me just show you S&P 500. And let's pull up on balance volume. And then I'm also going to pull up the AD line. So what happens here is on balance volume will go up if we finish up for the day. Doesn't matter whether we gap down and we came all the way back and finished up 1 penny. Doesn't mean if we gapped up 10% and then sold off 9.99% and we finished up 0.01. Doesn't matter what happened during the day. If we finished higher, OBV will take the volume and add it. All the volume. So again, it doesn't matter if we started up a penny and then went way up during the day and came back down and closed, but we're still up a penny for the day. All the volume is bullish. All of it gets added. The AD line in that same situation, let's say the S&P is at 6,100, and let's say we open at 6,110, and we go to 6,200, and then we come back down to close at 6,110. So during the trading day, we opened at 6,110, went to 6,200, we came back down 6,110. We are closed right at the low of the trading range for the day, ignoring the gap. I don't care about 6,100. We opened at 6,110. That's the low of the day. We went to 6,200, and we came back down, closed at 6,110. On an AD line, because you finished at the very low, the bottom of that day's trading range, even though you were up 10 points for the day, you finished at the bottom, 100% of that volume gets subtracted from the AD line. Whereas that same candle or that same day, OBV would take the entire volume and add it. Now that's the difference between the two. You look at them, they kind of look the same. But if you understand, like, I don't know, just trying to see, I mean, down here at the bottom, OBV actually put in a new low, April versus March. The AD line looks like it was just flat coming across here. Maybe that was a little bit of an advantage, making that call on the AD line. Then they both turned up, and right now they're both kind of doing the same thing. But anyway, I just wanted to point out the difference between the two. Because the AD line from back in 2020 during the pandemic, I noticed AD lines were going up, even though price action was going down. And that's when I started looking intraday. And I said, I'm going to start tracking how stocks do at the opening bell at 10 a.m. Eastern. Remember, the market opens at 9:30 Eastern. So I want to see what's happening in the first half hour of trading. Then 11 a.m. Eastern. So the next hour of trading. Then 2 p.m. in the afternoon Eastern. So then that's 3 hours across, middle part of the day. And then the close. So that gives me the final 2 hours. And what I did is, and I'll show you my spreadsheet of how I do this, but I ended up calculating all these different time periods of every single day and then go through periods. And so here, for instance, in this bearish manipulation phase, the gaps for all of the days in this period, all of the gap ups and downs netted to up $6. Then I call amateur hour that first 30 minutes of trading. So from 9:30 to 10 of every trading day within this period, just that half hour resulted in prices going up $4. And then 10 to 11 came down $19, and the balance of the day was up $8. But during this bearish manipulation phase, you can see the market was trying to go back up to new highs, but $10 of that strength came at the opening bell and during the first 30 minutes of trading. If you netted out the rest of the day, there was actually net selling that took place. So the market felt to me like it was being propped up. Early morning strength, market gaps up and then retail buyers jump in, just like any other period. That's what normally happens during uptrends. But then during that same period, we saw afternoon selling and Rotation, that's the key. It wasn't just this chart. It was also the rotation that we were seeing into defensive areas. All of this is lining up. And remember the sentiment issues. We were outside the channel. We had negative divergences. The 253-day put call ratio, remember at the beginning of 2022, it was just starting to turn up. All these things were coming together. And that's how we called that. But look at this distribution phase. So once all the manipulation is done, then we tend to go through a period of just pure outright selling. Market makers go on vacation. That's what I call it. We get gap downs. We get more. The market sells off very rapidly over a short period of time with not a whole lot of buying. I mean, you get market makers that'll trade, we get some short-term recoveries, but over the period, collectively, it is a mass distribution period. And what do I mean by that? Well, gaps. During this period, highlighted in red, the gaps of every one of these days totaled minus $29.68. Amateur hour, first 30 minutes of trading, minus $35.08. From 10 o'clock in the morning to 11 o'clock, minus $32.93. And then from 11 o'clock to 4 o'clock, minus $14.59. There was no safe haven. There was selling net during the trading day for this entire period, beginning of January through about the middle part of May. And then Wall Street firms started to accumulate. And that's what I call the bullish manipulation phase. Look at the gaps, minus $55 for this period. Now, think about this for a second, it's just common sense. We started this period at about 283. We ended this period at about 317. So we were up $34 in this period. Gaps, we went down $55. Amateur hour, first half hour. Everybody's still programmed to think, oh my gosh, we're going lower. We got gap downs. Market makers are still gapping things down. You're waking up. The headlines are horrible. We're getting gap downs. And as retail traders, we're jumping on board. We can't take it anymore. We're selling. We're getting the heck out. Then from 10 to 11, we get a little bit of positive action. Look at the balance of the day. From 11 in the morning until 4 in the afternoon during this period, we went up, the QQQ went up $96. That's a lot of buying. Some people, I remember, were pointing out, oh, short covering. Folks, this isn't short covering. Not from 11 o'clock in the morning until 4 o'clock in the afternoon. Short covering is going to come in at the end of the day, last 15 minutes. This isn't short covering. This is accumulation. This is gap downs, panic, morning weakness, and then Wall Street saying, come to Papa. Come on, we want to start building our positions. All these positions we got out of back during the bearish manipulation, now look at the prices we're getting. And now we're back in. That's the way the market works. So can we time the market according to Wall Street? No, you can't time the market. Nobody can time the market. Nobody knows how to do that. Well, of course they're going to tell you that, because otherwise, how are they going to get the sell up here and buy down here? You can time the market. I mean, again, go back and look at our calls. They're out there. A lot of them are public. I showed you emails that we sent out in real time. April 11th, or was it April 9th? Whatever that day was, we had the email that went out that Friday. And I said, I'm all in. I'm all in. All in. I don't know how I could be any clearer. Was it 2 or 3 days after the bottom? Now, here was my good friend, Jay Powell, who decided at the Jackson Hole Summit, where they have their annual Jackson Hole Summit, he said that the market had more pain ahead. He decided he wanted to start prognosticating, which, Fed chiefs are not great stock market prognosticators. Remember Greenspan? Remember his, what was it, back in 1996 when he said irrational exuberance? Market irrationally exuberant in 1996, just before we went on 4 of the best years in the stock market's history. So if you had listened to him, you'd have missed 4 of the best years ever. That's not their job. Their job is not to forecast the stock market. So don't even consider. They're no better. I just love this when Jamie Dimon says something about the overall stock market and everybody's like, "Ooh, Jamie Dimon, he doesn't like the market." Jamie Dimon never likes the stock market. I mean, he's always bearish. He's always bearish. It wasn't that long ago. He was like, "Oh, this is 50-50 stagflation." Stagflation, really? 1970s stagflation? That's what we're calling this? Back at an all-time high. Thanks, Jamie, for nothing. Jamie Dimon's a great president of JP Morgan, CEO. Awesome. He does a great job of running that company, and it shows. Company's all-time high. It's one of the best banks out there. I give him credit for what he does well, which is run a bank. As far as calling the stock market, he's putrid. He's horrible. Don't listen to Jamie Dimon when you're trying to figure out what you're going to do with your stocks. Don't listen to Fed Chief Powell when you're trying to figure out what you're going to do with your stocks. If I haven't taught you something in today, I don't know what to tell you, because I think the numbers, the charts, all this speak for itself. The story is there. You just have to interpret it. You have to do a little research, or just listen to us, because we're going to be doing the research. And by the way, there's always subtle changes in the market. If I thought that I had figured everything out in the stock market, I wouldn't really look forward to the next couple weeks, couple months, couple years, couple decades, hopefully. Nothing would drive me if I thought I had figured it all out. You know, it's like bowling. Once you throw a 300, how do you get any better? Now, not too many people have bowled a 300, but if you do, where's the upside? You already did it. It's like, you know, I golf. I made a hole in 1. I can't make a hole in 0. But no, I'm not going to, that's a bad analogy. I love golf. But you know, in the stock market, if nobody is ever going to learn everything, I'm going to learn something new on Monday. I can promise you. That's the way I approach the market. Always looking for something. When you see our manipulation spreadsheet on Excel, you'll understand. I mean, I'm calculating, I'm going crazy, trying to figure out how we can use this to our advantage, not just for our members and for the stocks that are on our manipulation spreadsheet, but I'm trying to develop a signal at Stock Charts. I'm going to meet with them later. And our members at Earnings Beats, or those folks who want to buy the signal, are going to have something that I think is going to be ridiculously valuable. But I'm in the phase right now of developing it. So again, trying to learn, trying to figure out exactly how to put that together. But anyway, we'll get into that in a minute. My point is, do you see how we go through these phases? And this is how Wall Street accumulates. You need that negativity. You need that fear and panic in a bear market to generate the number of shares being sold that Wall Street can accumulate to get back into their positions. And it happens through capitulation. It happens through all the fear and panic building. It happens through this mass distribution, and then going through this period of these large gap downs, followed by big recoveries. So with that, I'm going to show you my Excel spreadsheet. So bear with me, because I have to unshare my screen here for a second. All right, so you're seeing nothing on your screen right now. Just bear with me. All right. Let's try this. Well, I think I'm going to have to share my screen. Might be a little confusing here for a second. All right. Let me, you should be able to see everything now, which is probably good. I'm going to put this on the QQQ right now. So here's the QQQ. And this is kind of the period that we're going to be talking about. February down to March, this March low. Then we bounce. So if you're thinking about the phases, think about this phase. You know, everything happened much quicker than it did back in 2022. 2022, we ended up having a 9-10 month bear market. This was like a 2-month bear market. So everything's much quicker. But this first move down right here, volume picking up, this is the distribution phase. And you'll see it when I start pulling the numbers up on my Excel spreadsheet. Distribution, then kind of a little bit more sideways consolidation, little bounce. And then we go into these big gap downs followed by massive buying at the bottom. That is this is the manipulation phase right here. And then we turn back up and go back up to all-time highs. So when I'm looking at the Excel spreadsheet, what I'm going to do is I'm going to break it down by different periods. So the first period is going to be from the beginning of the year to January 23rd. And then we have this period where we go down, then back up to February 19th. So you got a period to begin the year, and then the final topping phase, February 19th. Then we're going to have a distribution phase down to March 13th. Then I'll show you some sideways action from March 13th toward, I think just maybe toward the end of March or maybe early April. I think it was like April 2nd right here. And then I did this phase where we started these gap downs. So let me show you now on Excel what that looks like. Let me know, Matt, John, anybody, if you can't see my screen, but this should be on the Excel spreadsheet now.
Yep, you're
so
good.
What I did on this spreadsheet is since the beginning of the year, I'm looking at the QQQ. So this is the QQQ. Here is the price action as of December 31st, 2024. Here's the opening price, 10 a.m., 11 a.m., 2 p.m., and the close, right? Over here, I'm taking the difference at the opening bell between the prior day's close and the open. You can see I jumped up $3.83 from here to here. There's the $3.83. At 10 a.m., we moved up $1.09 from the opening bell to 10 a.m. There's your $1.09. Then from 10 to 11, we fell 268, 515 down to 512 and change. And then from 11 to 2, we fell another $5.43, 512 to 507. And then into the close, we gained $2.89, right? So all I did is this for every day of the year for the QQQ. And come down here. And then and this is where we are right now, June 27th. And then I broke down 2025 right here. I'm going to make it just a little bigger, so hopefully everybody can see this a little better. So here was the breakdown. Remember I told you I was breaking it down from January to January 23rd, which was the first top on the S&P 500. Let's go back over. So right here, January to January 23rd or whatever that is right there. The next period, January 24th to February 19th. January 24th to February 19th. February 20th to March 13th. February 20th to March 13th. March 14th to April 2nd. So that's this consolidation period right there. And then April 3rd to April 7th. That was the real right here. April 3rd to April 7th. That was the real big, huge move to the downside, but most of it was gap downs and a little bit of intraday recovery. And then after the 7th, you can see that's when we started this move back to the upside. Let me see. I went the 7th. I went 8th to May 16th. So April 8th to May 16th. So right up to this top. And then from May 16th, I went May 17th to May 23rd, which was right here down to this selling. And then since then, from May 23rd on, May 24th to June 27th, we've been in this rally. Now, let's take a look at how this works. So January 1st to January 23rd. Remember in 2022, I said December of 2021, we had the gap ups. Remember? Had the gap ups. And then we had selling during the day. Well, January 1 to January 23. Look at what we had. Gap ups, encouraging everybody to get in. Folks, we're at an all-time high. Come on, jump in. And then we get the selling during the day. And so we only went up $22, even though we had gaps of $32. And all of that, by the way, was coinciding with technology. Remember, this is January. Remember those risk on ratios that I was showing you where they were turning lower in January and February, remember? So you got to picture this in your mind that we're getting these gap ups, we're getting sell-offs, and then we're also getting this bearish rotation all combined. Now we get our final move up January 24th to 19th. We know the rotation was horrific back then. We did have gap downs and then some buying back. So it's kind of a little bit confusing. It's almost like maybe we could combine these two periods. But the next period was not confusing at all. February 20th at the top. Let's go back and point this out again. Right there. So February 19th close all the way down to the March 13th close. This move right here was your pure distribution. Gap downs were only $4. We went down $71 during this period, by the way, on the QQQ. Only $4 of it was gap downs. This wasn't, any kind of manipulation. We're seeing just pure selling all day long. $4 at the open, $35 during amateur hour, that first half hour after the market opens. Another $14 sold in the next hour, another $10 in the next 3 hours, and then another $7 into the close. And by the way, all I'm doing here, this is just a net. So like February 20 to March 13th, if you look at the formula right up here, you'll see that I'm adding together H36 to H51. So H36 to H51, that should be February 20th to March 13th. H36 to H51 right here. H51, there it is. You look over here, that's February 20th to March 13th. So all I'm doing is I'm just netting everything that happened at the opening bell, and we're just putting it in as one total for the entire period. But you can see it's the only period we've had where it was just pure distribution the entire time. Now, what happened March 14th to April 2nd? Again, March 14th to April 2nd is right here. This is just the up, the down, the gap down, the recovery, a couple filled candles here. What happened during this period? Well, we had more gap downs, $17 worth of gap downs from March 14th to April 2nd. But the net over the balance of the day was plus $24. So we ended up actually going up almost $8 during this period. March 14th, right here, from this low to here. If you take that, we were up $8. Looks like from about 468 to 476. Right? But we gapped down $17 there. We're already starting to see some of that massive accumulation that I was talking about. $17 down at the open, but we rose $24 off of that. Now look at the April 3rd to the April 7th period. That's when we had the big drop. Remember I showed you on that email, April 3rd was down like 4 or 5%. April 4th was down like 4 or 5%. Then we had these crazy volatile periods. That's what this period was. These 3 days, 1, 2, 3, to set this bottom right here. We went from 476 down to just over 400 in 3 days. That's capitulation, folks. And there was that recovery. Now, you don't know it at the time. It's hard to make that call in real time that particular day. But you get a couple days in and you start seeing what the market's doing, especially this huge day. I think that's when President Trump had backed off some of the tariffs or whatever. And that's when we saw just crazy buying that day. Anyway, so in this period, from the 3rd to the 7th, we went down $52. 46 of it was gap downs. So during this massive drop, everybody's panicking. This is the worst thing ever. Oh my gosh, the sky's falling. 90% of the drop was market makers at the opening bell scaring folks. It was the news. It was the bad news that was out there. Everybody thought this, we were doomed. The tariffs were going to ruin us. Inflation was going to take off. Oh my gosh, stagflation. We got an economic situation brewing too. The Fed, going to raise rates. Well, they're not going to cut. We don't know what they're going to do. It was just awful, right? Well, I would say that the period from February 20th to March 13th was a whole lot worse, to be honest. That's where all the selling came in. I mean, April 3rd to April 7th, it was almost all gap downs. And then the rest of the day, we went down $6. This period, we only went down $6 during the day. Now, if you opened up your brokerage account, you tried to call Schwab and say, listen, Tom said we only went down $6 intraday. Why do you have me down $52? They're going to think you're nuts. Because we went down $52. Your portfolio went down 52. But it ain't the same as that 71 that was going down. That was distribution. This 52 is games being played. Now we got these big gap downs, and the actual selling after that was not nearly as great. And then take a look at the next period, folks. April 7th to May 16th. Now, all of a sudden, we're getting a lot more of these, Wall Street folks that are have already started to fill their coffers. Remember, from March 7th to April 7th, or from March 14th to April 7th, if you combine these two periods, you can see we went down $63 at the open over a period of 3.5 weeks. That's all it was. It was gap downs. From there, everybody was panicking, but we weren't selling off anymore. Wall Street was accumulating. And then once they get their fill, what happens? Now, all of a sudden, we're getting these gap ups. And this is normal during a secular bull market, by the way. Get used to this. If the market's going to keep going higher, which I think it is, we'll talk more about that on Monday and how high I think we could go. You're going to see more and more gap ups. This is the way the market works. Because anybody who hasn't gotten in is going to face that dilemma every single morning, or just about every morning, when they're looking at futures up again. And they're like, oh my gosh, because some people are thinking, oh, this is a double top. This is a double top. We're going to go back down. Did you see my ratios, my sustainability ratios? I wish you the best of luck, because Wall Street's getting in. They're not getting out. So if you think this market's going back down to 4,800 again on the S&P 500, I got a bridge I want to sell you. But this 41, these gap ups now are creating really difficult scenario for people that got out, just convinced that there's no way that this is real, that this isn't going to last, and we're going to go turn around and we're going to go right back down. You just wait. You just wait until the tariffs kick in. You just wait for inflation. You just wait. We got negative GDP, which, by the way, the market already called in advance. That's why we saw the market drop the way it did right before we got a negative GDP reading. All of these things, like I said, Wall Street's not dumb. They've got PhDs and MBAs all over those firms. They're getting the best of the best from Harvard and Columbia and all the Ivy League schools. They're a smart bunch of people. You think they don't know where the economy's going? I mean, they got a who's who list of economists that work for them that are probably a lot smarter than the Fed, to be quite honest. Anyway, they tell you what they're doing with their money. They're not going to tell you what they're doing on CNBC. But now we're into this thing where folks that got out are faced with, now we're at all-time highs. What if you got out, you panicked out back beginning of August or April, and now you're sitting here thinking, I can't get in now. There's no way I'm getting in now. I got to wait for the market to come back down. What are you going to do if the S&P is at 6,500? What about 7,000? I mean, at some point, you'll rationalize that it's okay to get back in the market, having left a lot of money on the table. It's just the way the market works. I wish I had an answer for you, but we do what we do to try and help our members get in and out ahead of time, because it's too late after the fact. By the time the Fed chief says, okay, things look better than we thought. Oh, inflation really hasn't been a problem. Back in January and February, they just kept talking about, when the tariffs take effect, when the tariffs take effect, when the tariffs take effect. Well, the tariffs have taken effect. And now they're saying, well, it takes time for it to get through the system. It takes time. kind of reminds me back, when they were talking about inflation. It's transitory. We're not worried about it. Then all of a sudden they were very worried about it. And then when we were waiting for inflation to come back down, they were like, well, we just need to see inflation start to roll back over. Then it started to roll back over, and they're like, well, we need a little bit more of a sustainable advance down toward our 2% target. It went from 6.7% down to, where is it now, 2.8% or whatever? And they're still making excuses, saying, well, we might see a little pop. I mean, I'm done with the Fed. Fed's horrible. They've gotten it all wrong. They eventually get it right, which is why we're back at all-time highs. Some might say, oh, well, the Fed's done a great job. Well, yeah, if you like 4 cyclical bear markets in 7 years, they've done a wonderful job. But that's been a lot of pain for a lot of people. And that's why people don't trust Wall Street. They don't trust the stock market. Part of it lays at the doorstep of the Fed because they have completely misused their tools over the past 7 years, in my opinion. I gave them a lot of benefit of the doubt during the pandemic, but I'm telling you, these last few years, having that 2022 bear market as deep as it was, and then having another bear market 3 years later in 2025, some of this is on the Fed's doorstep because they're mismanaging. They just are. I don't care. You can disagree with me. That's fine. It's just my opinion. I don't have any facts I can point to other than the fact the market just keeps getting clobbered every time Powell backtracks. Mr. Waffler. Anyhow, but look at where we are now on this May 24th to June 27th. I mean, we've gone up $38. 31 of it's at the gap. It used to be you didn't want to be in. You wanted to get out at the closing bell because you didn't know what you'd see the next morning. Now it's the opposite. Now you want to make sure you're in the market because we're gapping up almost every single day. Look at the QQQ. Here's the opening gaps. Here we were down $5.98. Okay, that's a pretty big down day. We're up $1. We're up $2. We're up $2. We're up $5, $3, $1, $3, $1, $5, $1, $7. I mean, since probably the last month, the number of gap ups, the dollars that you're missing by not being in at the opening bell are staggering because Wall Street's got their shares. They don't need to convince you of anything. They don't need to get you to sell. They got their shares. They're booked. They're booked. They're ready to go. The plane is taking off. We got all of our risk on stuff going up. So anyway, that's what I want to talk about with manipulation. I do want to show you one other thing though on the manipulation. This is something I just added. I'm just playing around, looking at relative AD, looking at the AD on individual stocks versus, and by the way, this manipulation spreadsheet, this is available to all annual members. We give this to our annual members. So if you do take us up on the deal for the flash sale, you'll get a copy. You'll have this Excel spreadsheet Monday morning. We update it every week. But anyway, what I'm doing right now is I'm looking at it for opportunities. I've got what I'm calling, and this might be something that develops into a stock chart signal. I'm trying to figure it out right now how I'm going to do this. But I'm looking at a 5-day relative AD, a 10-day relative AD, and a 20-day relative AD, looking at how the AD stacks up on these individual stocks versus the S&P 500. So in other words, if the S&P 500 opens flat and closes flat and just doesn't do anything during the day, and a stock like Coin gaps up or just wherever, opens wherever, and it moves up during the day, it's a relative AD winner versus the S&P. S&P was flat, but Coin's been going up. Then you get down like something like Palantir. Palantir got killed at the end of the week. I don't know if you probably saw that. Palantir was selling off all day long. So it is turned into a relative loser right now in terms of its relative AD line. So I'm looking at this relative 5-day, 10-day, 20-day. And what's interesting is we saw the discretionary area take off at the end of the week. Now, I think Uber might be considered a software stock, but Uber to me, it's like a consumer stock. I mean, they provide a consumer, a want, a need that we have, not a need, but a want. We could walk somewhere, or we could get an Uber, or we could take our own car, or we could, it's something that we want. So to me, it's more like a discretionary stock. But I love what's going on the chart right now in Uber. DoorDash, love what's going on the chart right now. DoorDash, as far as being accumulated. These are two I really like. Arista Networks, I think, looks really interesting right now. Coin, Celestica, these both might be getting a little toppy, but there were a couple here that are just starting to show some real signs of relative AD that I think could have really strong weeks ahead. So those are a couple of names, and I'll give you some more, but I'm planning on doing this setup every week and then just kind of following it and seeing what kind of signals that this is giving us. In other words, if a company is really showing a lot of relative strength in its AD line versus the S&P 500, is that a precursor to outperformance? I think it probably is. Remember why, and this is for members that have been Earnings Beats members for a while. Remember when we came out of April and I talked about all that manipulation? I said, best looking stock, bar none, of all these stocks that we were covering, the best looking stock coming out of that low in April was Netflix. Remember that? Netflix exploded after I said that to the upside. We were at like, I think 800 and change. I'm going to pull up Netflix. So coming out here, Netflix was at 855 back on April the 4th. And I said, this stock looks like it's really being accumulated. Look at what has gone on with the price of the stock. It got up, it's over 1,300 now. It's been one of the best performing stocks. And it all came, most of that, or almost all that strength came after it showed up as being one of the best AD stocks on our list. And then shortly thereafter, I gave Tesla. Right when it was about to break above 300, it exploded. I think it went up to like 480 or something shortly after that. Now it's come all the way back down, and it's not one of the favored stocks right now, for sure. Microsoft was another one I talked about that was being heavily accumulated in the afternoons back in April, March, April period. Remember that? I mean, Microsoft's been an awesome stock since then. So again, this is just some of the research, some of the stuff we do behind the scenes that, I'll be honest, most of the people at stock charts are never going to see. I might talk about it a little bit on my YouTube shows, but the folks that are benefiting from this kind of information are our members at Earnings Beats. And like I said, when I go through, and it's not just me, I mean, I got folks helping me at behind the scenes at Earnings Beats that are putting in hours and hours and hours and hours of time right now, manually trying to come up with, helping me come up with a signal that we can maybe use over at stock charts. It might be an Earnings Beats signal that's going to benefit those that are Earnings Beats members. I can promise you that. But there's a lot of work that goes into this. We do so much research. I would love to be able to lay out the number of hours research we do versus every other company. I would love to know how much time other companies are putting into researching how the market works and individual stocks and how they might benefit and so forth. Anyhow, we've gone on and on and on, but please make sure you sign up for that flash sale. If you're not already a member, or if you're a monthly member or a trial member, use this flash sale as an opportunity to jump in and save yourself a ton of money. So there's the flash sale. If you go over to Earnings Beats, to our website, you will see the link right there, flash sale. Click on it. You can go in. And John threw in there an extra month if you sign up today. So if you sign up today, Saturday, we'll give you a 13th month. And I can only tell you that monthly, if you're a monthly member or you sign up and you just want to be a monthly member to get a little more flexibility, you pay $147 a month. If you sign up under this annual deal and you get 13 months, you can do the math. $797 divided by 13, that's probably like 60 bucks a month. That's quite a bit of savings over $147 a month. You commit to us and we commit to you. You'll get our research, all of our chart lists that we do, all of the Excel spreadsheets, or just about all of them. There might be something proprietary that I might hold back. I just don't want to get out. But the majority, the overwhelming majority of our work that we do and all the research, literally we just hand it to you. We send it, you get a little link and you just download it. All of our hours and hours and hours and hours and hours of sweat and tears, you just download it into your account and you can start looking at it. Anyway, John, I don't know. Oh, I'm just going to give you a couple of stocks because one thing that I'm watching for in the market, I know we ran way over, but my gosh, this stuff's so important. Let me pull up IWM. A lot of members know I saw this bottoming head and shoulder pattern, reverse head and shoulder, neckline coming across. We broke out, we pulled back, we held the rising 20-day moving average, and I think we're in an uptrend now. So I like the IWM. I like the triple leveraged TNA that tracks the IWM at a 3-to-1 clip. If you make money, it's great. You're making 3 times what you make on the IWM. If you lose money, not so great. You're losing it at 3 times a clip. So understand the risks, please. But as long as we continue to trend above that 20-day moving average, I really like the leveraged ETF. Another area that I'm watching, I don't own it right now, but I am watching it, is the XBI, which is biotech. Now, biotech's been going down. Biotech seasonally loves the month of July, which is right around the corner. And right now, the XBI is broken above the 20-day, and it's hovering above the 20-day. So it looks like we might get another push here in the XBI. Well, what tracks the XBI? 3 times LABU. So it is sitting here waiting potentially for an XBI breakout. But if the XBI breaks out, biotechs, this is an interesting potential 3-to-1 candidate as well. But again, I'm just going to throw out there, we are not registered investment advisors. I am not advising. I'm not recommending. I'm educating. If the XBI breaks out, moves higher, LABU is going to go up 3 times the amount. So, take that for what it's worth. Like I said, biotechs love the month of July. They really love the summer. It should have already been going. And maybe you can make the argument that this group has been improving here over, I think, May, June, July, maybe May, June, July, August. Those 3 or 4 months have historically been the best months for biotechs, and biotechs have improved, but another breakout would be really bullish. And this group can move very, very fast when it gets moving to the upside. Also, there are a lot of small cap biotechs. So if the biotechs get going, that could be something also that really adds to the strength. Excuse me, in the IWM, that small cap IWM. So this is an area to watch. Some other areas that do well over the summer months, I just wanted to point out because I said I would talk to you about potential winners ahead. Technology and discretionary both love as we go forward. So let me pull these up real quick. XLK, this is discretion or technology. If we go back the last 20 years, you can see how things really pick up. Look at July, one of the best months, actually the best month in terms of the odds of technology going higher, 80% during the month of July. Also, the average gain during July in technology, 3.2%, is the best of any month over the last 20 years. All right, XLY, do the same thing, 20 years. Look at July, 74% of the time, the average gain, 3%. Highest of any month over the last 20 years. Folks, those are the top 2 areas of the stock market. I mean, it's over 42% of the S&P 500. So if those 2 areas are already looking good technically, which they are, here's XLK, beautiful breakout finally above all this consolidation. XLY just made a breakout after a kind of a flag had formed for the last 6 weeks. Nice move up off the April lows, kind of a sideways flag. We just broke out on Friday, and look at the close. Look at the move in the final hour. I think a lot of program trading was kicking in. I think there are a lot of folks jumping in right now to discretionary stocks. So those are a couple areas that do well in July, a couple areas to look at. Within those spaces, one area that it has not been performing well that I'm going to be watching, computer hardware. Think Apple. They have not been performing well, but month of July, this is one of the strongest areas of the market historically, July and August. Let me show you seasonality on DJUSCR. Last 5 years, July, 100% of the time up. But let's go back last 20 years. 84% of July's, this industry group has been up, computer hardware. Look at the average gain, 5.6%. More than double except for August, which is the next month. These 2 months combined, computer hardware average is going up 8.7%. That's an average over the last 20 years. We got one more day and then we move into the July. And if you're wondering, Apple is one of the strongest stocks in July and August last 20 years. Look at July, averaging up 7.6%. It goes up 90% of July's. That's 18 of the last 20. And August goes up 63% of the time and average gaining 4.2. Apple over the last 20 years has averaged gaining almost 12% during the months of July and August. I know you're looking at it like I am right now, saying, hey, it's dead. Yeah, it's dead a lot of times heading into July, and then it picks up. So let's watch. If Apple starts to make a break above 205, which is where we've seen a lot of failures over the last few weeks, I would say that it's probably about to begin what could be a very significant run to the upside heading toward its earnings. So Apple, just keep it in mind. I'm just pointing out the seasonality. The XLY, June through September. Semiconductors and software tend to do really well over the summer months. That's the two groups that are leading the market right now. Within the discretionary, recreational services just broke out. Restaurants. Let me pull up the restaurants real quick. Looked to me like they were maybe just making this breakout. Look at all these tops going back 3 months, 3,100. We closed at 3,102.99. That could be the start of a big move in restaurants coming up this week. So I know you've heard of Restaurant Week before. I'm going to rename it. The upcoming week is going to be Restaurant Week. Specialty retail, travel and tourism. Let me pull up travel, tourism. These are a couple other areas. So think about stocks like there was another stock I was going to give, Booking. I'll show you Booking Holdings in just a second. Travel and tourism, look, just made the breakout, coming off a centerline test on the PPO. I mean, this thing couldn't look much better. And then we got stock like Booking. Look at the breakout, just made the breakout above 5,600. What else did we have? I'm going to give you a couple of other individual stocks. I talked about Arista Networks from the manipulation spreadsheet. It just broke up above 100, pulled back on Friday to test the breakout level. Also on the 60-minute chart, it came down, tested the rising 20-hour EMA. I think ANET could have a strong week next week. Talked about Booking. Disney just making a breakout. Look at the tops over here, right around 117.50, 118. This one was up to 120. Successful 20-day test and another breakout. Love what's going on with Disney. You want a small stock? Last one I'll give you. How about CommScope? This stock was had a huge run, went sideways for many months, and just this last week, look at the volume coming in the breakout. Now, maybe we get a pullback somewhere in the 7.25 range. Keep a little powder dry, but if you can get it back down in that range, I think CommScope could be a really interesting, risky, really risky kind of trade. Small cap stock there. All right, John, I know we went way over, so I apologize to everybody, but I tell you what, I didn't take a deep breath anywhere during the entire thing. I mean, there's so much stuff to cover, and I got so much more. You know, we talked a lot about what was in the rearview mirror and how we made all these calls and what we need to look for. Monday, I'm going to be looking ahead, and I'm going to be talking to everybody about where I think we're going, which I think is going to be really important, and certain pitfalls that you can look for along the way, some areas of support if we do pull back. All those things are going to be included on Monday. And again, if you do sign up under our flash sale and you become an annual member, we'll see you on Monday, because that is for our annual members. We do this every quarter to update. We used to do the Market Vision events at the beginning of the year, and that was that. We've now added so that 3 times a year, March 31st, June 30, September 30, we have updates to Market Vision before our next event, which will be January of 2026. So anyhow, these have proven to be very valuable. Even at the last one, I was listening at March 30th, and I was looking at that discretionary staples ratio. And I said back then, you can go back and listen to the recording, but I said back then, I thought we had one more low. We were going to go down one more time, which is what we did at the beginning of April. And then we rallied. I'm going to give you my third quarter outlook on Monday, and you're not going to want to miss it. So I'll be happy to answer any questions, John.
All right. So John actually had to run.
Okay.
If you wanted to check out your Slack channel, I just emailed or messaged you the questions that had popped up. on your personal
Okay.
Slack. Yep.
Yeah, I don't have it on my computer, but I can get it on my phone.
All right, cool. Yeah, I'm gonna have to step away too. So
Okay. All right. I don't know how many of these questions I'm gonna be able to get to. Obviously, we're already 2.5 hours in. I thought I'd be done in an hour and a half, but I tell you, this stuff is so hard to get through. On this manipulation phase chart, how does Tom know where to divide the phases? It was just, taking a move down and then a recovery period, and then taking a move down, a recovery period. The order of the phases you go through, you pretty much know. You're going to have some sort of manipulation phase at the top, then you're going to have a distribution, then you're going to have manipulation at the bottom. So I kind of know the order I'm looking for it in, and I didn't do anything crazy. I just put the numbers together. I showed you how I put the dates together. Why are the S&P 500 uptrend lines so exaggerated since 2020 compared to prior years? Why are the S&P uptrend lines so exaggerated? I guess, well, first of all, since 2020, you're coming off of a panicked low. So you're always going to have a much more rapid trend line going up off of 2020. But that's the channel lines that I use, I think, for the last 15 years. That's what I tend to focus off of. If you get into a short-term uptrend, and you're going up 15% in a month or over a couple of months, that's not sustainable. You can't keep going up 15% every 2 or 3 months or whatever. So, the shorter the trend line, the more likely it is it's going to get broken. That's just, I think, some common sense. How this July will be different from July 23 or July 24, where there was 10% correction in the following month. Well, we just came off a bottom in April. So, literally, we're just setting a new all-time high historically, and we're doing it, by the way, with a lot of help from aggressive areas of the market. So this is a risk-on type of market. There have been plenty of Julys and where we've gone up. I just showed you that for technology's best month has been July over the last 20 years. It's gone up 18 of the last 20 months. So I can point out some pretty bullish historical and seasonal information that would certainly offset the last 2 years. I wouldn't be using 2 years as a trend, by the way. Future of crypto and comments of Tesla. I don't, you can only be an expert in so many things. I am not an expert in crypto. Just like I'm not an expert in gold and commodities. I really miss my late friend, Greg Schnell at Stock Charts. He and I used to have great discussions about commodities because he was on top of that stuff all the time. And so I'd get a lot of really good, useful information you don't even see on the charts from Greg because he was so knowledgeable in those areas. But I just follow the charts. I'm not experts in those areas. I'm certainly not an expert on cryptos. I don't trade crypto. For those of you that do and are making lots of money, congratulations. That's awesome. I can only do so much. I've only got so much RAM and I can only be spread so thin. I just don't have the time nor the inclination to try and learn everything I need to know with currencies, cryptocurrencies. So I follow the charts. They're trending up. Great. If I like Bitcoin. I like probably a little lesser extent, maybe XRP, and then maybe even Ethereum, kind of in that order. But that's just from looking at charts over time. And again, I'm no expert, so please find an expert that knows more than me. Discuss the bullish percent index if he finds value in it. I don't use it. It's a stock charts thing. There's lots of stock charts things. So I'm going to just pass on that. Do I smell a new indicator at SC coming soon? Yes, you do. I don't know what it's going to be. I don't know when it's going to be, but I'm racking my brain right now. Just about, if you don't know what I'm doing, if you haven't heard from me in a while and you're not quite sure what I might be working on, chances are it's going to be on that spreadsheet. What is with Apple and TLT? Yeah, you go through period. Not everything goes up at the same time. I could say that about a lot of discretionary stocks that haven't been performing, for a while. Amazon really hasn't done nearly as well. What about Google? It's kind of comes to life once in a while. They all have their own thing. And then you look at Netflix, it's going crazy. Meta going crazy. Microsoft now going crazy. They move. They don't move all at the same time. They rotate. And so right now, Apple's just out of favor. But based on what I showed you on seasonality, if it comes back into favor, if you start seeing the technical strength, just understand you've got tailwinds. You've got historical tailwinds that could really help carry you there. Do you think this market is starting to price in rate cuts? I think the market, yes. Yeah, answer is yes. That's all the money rotating into growth. That's part of that. Let's see. Another questions. Oh, a couple more. One more. Can you review UNH? I don't really want to get into individual stocks. I've been doing this 2.5 hours now. I could sit here and look at individual stocks for the next 3 days. And I like doing it. I just want to give myself a break here. I mean, it's probably, I haven't seen it recently, but, got hammered on a lot of volume. I usually let those stocks sit for a while, until they start to show leadership. But that's basically it. So I do want to, really thank everybody for coming in. Again, we don't do this often. We do, when you take time out of your day to come in and listen to us, especially those of you that are new to earnings beats, we want to give you a good offer. This is as good as it gets. 20% off for a full year. So normal price $997. We're cutting it to $797. We're going to cut $200 off of this for you. And if you sign up today, we'll give you an extra month, 13 months for the price of 12 and $200 off on that price of 12. So this is, like I said, great deal. Works out probably to about $60 a month. If nothing else, I mean, if you don't think that what I've shown you today is worth $60 a month for the next 13 months and what it could mean based on the various calls that we make, I don't know what to tell you. I think we're worth way more than what we charge. Obviously, we try to make it as affordable as we can because we want as many members as we can. I mean, I could do a service and just get hedge funds, and it would be, I'd probably charge hedge funds $10,000 a month or, whatever. They pay a lot of money. But I want to help out the little guy. I want to help the folks out like me that are, trying to figure out how to make a better financial future for themselves and their family. And constantly, I mean, I hear it every single day at our club here in South Carolina. I got a lot of friends. They're talking about stuff they see on the news. And it's just like, and then they're like, how can the market, they'll tell me, Tom, how can the market go up? Look at what's going on. And I'm like, well, how much time do you got? Because I'm going to have to get my phone out. We're going to have to start looking at some charts because I'm going to show you why the market's going to go up. Anyway, that's what we do. And we try to give back. I mean, obviously, if we could do this for free for everybody, if somebody wants to offer up and pay advertising to cover all of us, you can advertise on all the stuff we do for free, that'd be great. No, I won't have to charge anybody anything. But anyway, this is the way that we have to do it. And like I said, I think the cost is pretty darn reasonable considering what we do. And if you look back over the last few years, we just keep tacking on more and more services. And the price is pretty much the same with discounts while everybody else is raising prices and everything. And I don't know what we're going to do for next year, but at some point we might have to, have a price increase. But we're still going to come to you with these flash sales. We're still always going to try and give you discounts and opportunities to join us and follow along and learn. It's been a learning experience for me for 45 years since I first started looking at the stock market when I was in college. And, it's still a learning experience. I'm still learning every day. Like I said, I'm still working on that manipulation spreadsheet. I'm never going to figure it all out. But what I do figure out, I'm going to pass along to you all. So hopefully you enjoyed today's session. Please, please, please hit that like button if you liked the show today. Also subscribe to our channel. The more people that subscribe, even if you can't make it when we go live, sometimes it's all built into the algorithms and so forth at YouTube. And it really helps us get our word out and helps us build our community on YouTube, which ultimately helps us build our paid subscription service as well. So even things like that, clicking the like button and subscribing really helps us as well. So I want to thank everybody, whatever your support is, or has been or will be going forward. I really appreciate it. And want to just send a big thank you out to everybody. And hopefully, you're learning things and, we're producing on our side as well. But have a great rest of your weekend, everybody. We will be doing that Q3 update on Monday evening after the close, though, and you don't want to miss that. So please take advantage of this offer we're giving you. Have a great day. Happy trading.